Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Making Community Banking Great Again. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for a 4-minute opening statement. Welcome to the House Financial Services Committee's first hearing for the 119th Congress. I'm delighted to serve as chair, and I look forward to working with my subcommittee chairs, Ranking Member Waters, and all the members of the committee to bring common sense back to financial and economic policy that will both foster prosperity and growth for all of our citizens. That's the change that President Trump ran on, and that's what we're going to do in this committee. It's been nearly 100 years since the House Financial Services Committee was chaired by somebody that had financial experience before their time in Congress. Many of you know that I was a community banker before being elected to Congress, and I want to bring being a banker and business vision to the committee. And one of the key pillars of that vision is indeed to try to make community banking great again. It's no coincidence that this is the theme for my first hearing of the chairmanship. Most countries have just a handful of large national banks, but the United States has a large and diverse banking system with thousands of banks from small and regional institutions to global money center banks that all coexist and work together with each other to meet the capital access needs and depository needs of our Americans. It's one of our great competitive advantages. Alexander Hamilton, our first Treasury Secretary, himself said, "Banks are the nurseries of the national wealth." When faced with unprecedented uncertainty during the time of the pandemic, it was our community banks that made an outsized share of the Paycheck Protection loans to small businesses, keeping millions of Americans employed. Community banks know their communities best, and research shows that when they close their doors, Americans suffer. Right now, our community banks are disappearing across the country. Back in 1999, when I first founded my Arkansas-based company, Delta Trust and Banking Corp., the United States had over 8,500 FDIC-insured banks, including 190 new charters that year. Fast forward to today, the United States has 4,000 banks, while only 82 de novo charters have been issued since 2010. Small community banks and credit unions have suffered immensely under the regulatory requirements, forcing them to devote more and more resources to lawyers and check-the-box compliance programs instead of serving their customers. Back in 1995, Arkansas had 251 banks. Today, it's 77. However, our local community banks and credit unions did not contribute to the financial crisis. They've continued to serve the critical engines for local economies, despite being subjected to much of the same regulatory burden and regime as the largest, most complex institutions. To form a new bank today, Americans must submit a multi-year, high-cost endeavor with several different federal agencies just before they can be considered to open their doors. Initial capital requirements can be as high as $30 million in practice, making it nearly impossible to get started as an entrepreneur banker today. One founder in Texas told me that regulators were asking him to propose $50 million in paid-in capital before he could open his doors. Over the last year, I've met with bankers from across America, including in Arkansas, Texas, Ohio, Florida, Oklahoma, Louisiana, and elsewhere. And these visits have reinforced my view that we're not doing enough to ensure that banks of all sizes remain competitive, both in their business model and in their ability to attract growth capital. That's why last November I released my principles that we're starting to talk about today, Making Community Banking Great Again. 30-plus reform ideas to enhance the ability for financial institutions to serve their customers, attract investment, and adopt and deploy technology and grow their communities. I look forward to working with all my colleagues to, in fact, bring that to fruition. I'd like to first have the ranking member and I visit about a point of personal privilege. I want to acknowledge 2 staffers for their service on our committee. First, from the majority, Kim Betts and Larry Seifried have done so much work to make this committee strong and outstanding over the past few years. Both are moving on. Friday will be their last day with the committee. Kim's been a key staffer here for the past 6 years. She's been general counsel, policy director, deputy staff director, and staff director. And Chairman Cole and Subcommittee Chairman Joyce have enticed her over to the House Appropriations Committee. So she won't be going far, and I consider her a world-class double agent in appropriations, absolutely watching out for those of us on the authorizing committee. Larry's been served as Director of Member Services and Coalitions during the 118th Congress, Deputy Director of Coalitions in this Congress. His work to make sure our members and their offices get what they need to be successful has been integral to the success of our committee in the last Congress and this one. So we've benefited mightily from Kim and Larry's leadership and hard work, and I want to thank you for your service to our committee very much. And now I'd like to recognize my friend, the ranking member of the committee, the gentlewoman from California, for a point of personal privilege.
Thank you very much, Mr. Chairman. I would like to acknowledge Esther Kong, the Democrats' chief counsel, who will be departing Congress at the end of this week. Esther has served ably on my staff for 11 years. She first joined the committee in 2014 as a fellow, fresh out of law school. She quickly distinguished herself with a sharp thinking and keen sense for public policy, and was soon hired full-time onto the committee staff. As a staffer covering housing issues, Esther worked on a variety of issues, including the reauthorization of the Native American Housing and Self-Determination Act, the enactment of the Housing Opportunity through Modernization Act, and the reforms to the National Flood Insurance Program. Later, she became our Director of Housing Policy, leading a team of housing professionals and shepherding the committee's response to the housing challenges caused by the COVID-19 pandemic, though the House and into law. In 2020, Esther was promoted to be the committee's chief counsel, and in that role, she has refined the committee's processes and procedures, expanded our member services operation, worked across the aisle on bipartisan legislation, and given the Republicans a hard time on every now and then. When it comes to enforcing the rules, Esther is driven, determined, and hardworking, but also very kind, thoughtful, and a mentor to current and former staff, many of whom are now her close friends outside the office. She's a proud wife to her husband, Corey, who is a teacher at a DC school, and she is even prouder godmother to Hosea, who we see and hear in the office from time to time. We all are going to miss Esther, and I will miss her smile, her laugh, and her no-sense attitude. All of us are incredibly proud of her and wish her the best as she embarks on this next phase of her life, and thank her for her service. And thank you, Mr. Chairman, and I yield back.
I thank the ranking member. I couldn't agree with her more on the incredible, wonderful staff we have on both sides of the aisle and how we're grateful for their service to the committee and on behalf of the American people. I now recognize the ranking member for 4 minutes for an opening statement.
Good morning, everyone. Today we're here to discuss how to strengthen community banks and credit unions, vital institutions that are lifelines for families and small businesses all across the country, particularly in underserved communities. This committee has a long bipartisan track record of supporting all of these community lenders, including during the pandemic by allocating $60 billion for them to deploy emergency loans to small businesses and investing $12 billion to grow minority depository institutions and community development financial institutions, many of which are small banks and credit unions. If it were any other day, I would say that I hope we can build on these efforts, including by passing my bill to expand depository insurance to protect the payrolls of small businesses and their employees who want to keep their money at their banks. But I cannot do so as an unelected billionaire, Elon Musk, seizes control of the American people's money. Meanwhile, President Trump unlawfully blocks sending money rightfully owed to Americans, imposes new import taxes on Americans and businesses, buying everyday goods, and fires the federal cops that go after everyone from Wall Street executives to violent insurrectionist criminals. Each of Trump's and co-President Musk's actions are designed to cut taxes for billionaires and give corporations free rein to rip off working-class families. If the community banks listening today, if they're listening, they should be worried about what's happening to their customers and small business clients and what they should be doing. Trump is waging a trade war by threatening to tax Americans whenever they buy fruit, vegetables, gas, and even housing. And our small businesses will indeed feel the pain when they buy and sell their products. Even the Wall Street Journal has called Trump's import taxes the dumbest trade war in history. And frankly, I agree. Mr. Chairman, I don't have to tell you who these hardworking people refer to bank with them. That's right, community banks and credit unions. I know Republicans have noticed several so-called reform bills, but bank exam appeals, reporting requirements, and even capital levels completely misses the point when community banks' customers are being fleeced. Trump and his team are firing hundreds of federal regulators hired in the last 2 years. This was after Trump imposed a hiring freeze, gutted fair hiring initiatives mandated by law, and suspended all enforcement of consumer laws so that big banks like Wells Fargo can go right back to their old tricks. I know that you are sincere, and I know that you have done a lot for community banks and you want to continue to do, and we want to work with you, but it's difficult when the President of the United States is offering initiatives and executive orders that really undermine community banks. I yield back.
The gentlewoman yields back. I now recognize the chairman of the Financial Institutions Subcommittee for Mr. Barr of Kentucky for 1 minute.
Thank you, Mr. Chairman. I'm pleased the first full committee hearing of the 119th Congress is focused on issues I've long cared about, and it's a credit to our chairman for focusing and prioritizing issues related to community banks. Today, we're going to discuss how we can unbridle those community banks from the regulatory burden of the Biden administration and the Dodd-Frank Act and allow them to focus on what they do best, serving American families, farmers, and small businesses. Throughout my time in Congress, I've pushed for changes to the regulatory landscape that promote competition, ensure right-sizing, and hold regulators accountable. I was proud to reintroduce H.R. 478, the Promoting New Bank Formation Act, a bill to reduce burdensome initial capital requirements and lending restrictions that have made de novo bank formation all but non-existent over the last decade. In addition to promoting new bank formation, we need to repeal the disastrous 1071 rulemaking and implement an independent appeals process to curtail regulatory overreach. I look forward to continuing to lead the Financial Institutions Subcommittee and getting to work.
Gentleman yields back. Chair recognizes the ranking member of the subcommittee for financial institutions, Mr. Foster of Illinois, for 1 minute.
Thank you, Chairman Hill, and to our witnesses. The state of Illinois is home to more than 500 community banks and credit unions, employing over 41,000 Illinois residents. When I was starting a business with my brother years ago, I learned the value of having many banks, large and small, competing for our business. It allowed us to shop around for the interest rates and lending terms that were best fit for our situation. And today, community banks and credit unions face many challenges. They do not have the scale to compete with mega banks for large accounts, and they often do not have the technology or the consumer data to compete with online banks and fintechs for smaller accounts. And now they're faced with a specter of competing against online payment systems like X-Money at the same time that X-owners Elon Musk has been given unprecedented access to private payment data on every American business and every American. Small bank customers were hit hard during the tariff wars of the first Trump administration, which threw us into a manufacturing recession a full year before COVID hit, and retaliatory tariffs devastated farm export markets in small towns across America, requiring a $20 billion taxpayer-funded bailout simply to keep U.S. farmers afloat. But small banks matter, and I look forward to working with the chair in this committee to address many of these issues. I yield back.
Gentleman's time has expired. Today, we welcome the testimony of Mr. Pat Kennedy, Jr., founding partner of the law firm Kennedy Sutherland in San Antonio, Ms. Susannah Marshall, who's the bank commissioner from the Arkansas State Bank Department, Cathy Owen, executive chairman of Eagle Bank and Trust, located in Little Rock, Arkansas, Rebecca Romero Rainey, president and CEO of the Independent Community Bankers of America, and Mitria vice president of federal policy for the Center for Responsible Lending. We welcome all of you. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written testimony will be made part of the record. Mr. Kennedy, we start with you. You're recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Waters, and members of the committee. Thank you very much for inviting me to attend this hearing and submit written testimony. I've been a practicing lawyer representing community banks for 45 years. Their shareholders, directors and officers, and related entities on a wide range of matters. So I've had a lot of exposure to the industry. I'm also the principal shareholder of a Texas state savings bank with roots in rural West Texas, which in the last 5 years had, during the PPP, as Chair Waters had commented, this little small bank did over 10,000 PPP loans, average size of about 11,000. We ended up as a little small community bank being the 10th largest Main Street lender in the country. A firm called Wells Fargo was number 7. When I last had the opportunity to testify before this committee's subcommittee on financial institutions at the invitation of Congressman Luetkemeyer in 2017, there were 6,300 banks in the United States. As of last September, 30% of those are gone, and we have about 4,500 banks today. This loss is extremely unfortunate and is a trend that I strongly encourage Congress to reverse. In my professional career, I've witnessed the value of having locally owned and operated banks, particularly in rural communities. No other country in the world has anything like this historic population. It's a unique element of the American economy, and unfortunately, in the last 15 years, particularly since the enactment of Dodd-Frank, has undergone significant stress, and that is the reason for the continual decline. Prior to 2008, there were approximately, as the chairman noted, 200 new charters annually over the prior 20 years. Today, that number has dwindled to something like 7 per year. During that same period, capital ratios and the Basel Committee, the European-based Basel Committee initiatives have been designed really for the largest banks in the world, but have been trickled down and forced on every community bank, even the smallest community banks, and placed enormous burdens on this unique set of an important group of banks. Despite the laudable attempts of Congress during the first term during President Trump's first term to lessen that burden by the establishment of the community bank leverage ratio concept, getting away from the Basel at 9%, that still is a higher number and really continues to put pressure on profitability of community banks, and I think discourages entrance into the business. 27 years ago, I was involved in, and thankfully Congress adopted an amendment to the Internal Revenue Code that permitted banks for the first time to elect subchapter S tax treatment, and that has been credited as one of the most important pieces of legislation, unknowingly, that has affected positively community banks in the last 50 years. About a third of the banks in the United States, at that time there were 13,000, I think, and today there, as we said, 4,500. About a third of the banks in the United States maintain a subchapter S election, and that was continued in the Tax Act of 2017 in Section 199A that expires this year, and so I call that to the attention of the committee. I know it's in the purview of the Ways and Means Committee, but it's extremely important that we make that provision permanent for the benefit of some 1,500 community banks, most of them rural-based. While there are many other laudable initiatives identified by the chairman in his initiatives, I want to underscore the importance of encouraging and allowing responsible innovation by community banks. Financial technology has and will continue to create substantial value for the industry through efficiency and a reduction of costs, but it's important that we have a regulatory framework that allows that innovation. I would also point that it's really important that we have open and timely discussion of material supervisory determinations. Public enforcement action should, in my view, be reserved really for the most egregious situations, and cooperative and open dialogue should be the word for the future. Finally, I believe that the appropriate pricing of examination and application fees may need to be adjusted so that the industry is self-funding and the regulatory burden that is on community banks is lessened. Thank you very much.
Thank you, Mr. Kennedy. Commissioner Marshall, you're recognized for 5 minutes.
Good morning, Chairman Hill, Ranking Member Waters, and members of the Financial Services Committee. My name is Susannah Marshall, and I am the Commissioner of the Arkansas State Bank Department. I also serve as the Arkansas Securities Commissioner and on the Executive Committee of the Conference of State Bank Supervisors. I have dedicated my entire career to the banking and regulatory industry, starting as a commercial bank examiner in 1995. As Commissioner, I regularly travel across Arkansas and spend time at our banks, talking with bankers about their issues and working to understand the challenges facing the institutions, our economy, and consumers. The dual banking system and our state supervisors are a fundamental part of our U.S. financial services market that supports varied business models and brings together differing regulatory perspectives to produce better outcomes for our consumers and our local economies. States charter and are the primary regulator of 79% of the nation's banks, most of which are community banks. In general, these banks have assets under $10 billion, traditional business models, limited geographic footprints, and less complex risk profiles. They pose minimal financial stability risk. The 70 banks my department oversees are all community banks in the truest sense, regardless of any regulatory or supervisory definition. Community banks are the economic bedrock of their communities and the solid foundation for the overall U.S. economy. Yet over the last decade, we have lost nearly 2,000 community banks, 1/3 of their numbers in 2014, and only 62 de novo community banks formed over that same period. Like many of my state supervisor colleagues, my department has a mandate for safety and soundness, consumer protection, and economic growth. We are accountable to the local communities and local institutions. A healthy economy means that all consumers, no matter where they live, have access to a broad array of financial services. Community banks are central to this mission. They are a core component of a vibrant economy, especially in rural areas. In 1/4 of U.S. counties, a community bank is the only physical banking presence, and nearly 2/3 of all rural deposits are held by community banks. When community banks close, their neighborhoods suffer, and low-income households are often the hardest hit. Our nation's institutions simply do not reach the areas that depend on community banks for their economic support. Those largest institutions don't reach those areas. Their business models are not an adequate substitute for the relationship lending model so crucial to local small businesses and entrepreneurs. That is why state supervisors care so deeply about the health, vitality, and future of the community banking business model. Unfortunately, this model is under tremendous pressure from a multitude of forces, from increased competition and funding challenges to high technology and personnel cost. In addition to these headwinds, a heavy blanket of ever-increasing federal regulatory and compliance costs is smothering an already severely stressed community banking sector. To preserve community banking and support the communities that rely on these institutions, we must act now. Regulations for community banks should be tailored to limit their risk profiles. We must focus federal supervision on core safety and soundness risk and avoid imposing a process tax on banks. This supervisory approach often distracts bankers from financial issues that could actually pose significant risk to their institutions. One such area in need of fundamental reform is the BSA/AML supervision. No one in our financial system wants it to be used by criminals or terrorists, but the current BSA AML regime is burdensome, its effectiveness is often unclear, and the associated compliance costs are strangling smaller institutions. Static regulatory thresholds that penalize banks for growing alongside the economy should be indexed or discarded for rules that focus on the relative complexity and business models and risk of the institution. Community banks must also continue to innovate. The next generation of customers is demanding more convenient access to services and new and innovative financial products. Federal regulators, however, have responded with vague guidance and ever-increasing supervisory expectations that can stifle new business models. A culture shift among our federal counterparts and meaningful coordination with state regulators can help harness the benefits of new technologies and protect consumers. Changes to the regulatory framework and the process for approving de novo applications should encourage new market entrants. Healthy merger applications, particularly local-to-local mergers that preserve community banks, must be considered in a timely, transparent, and fair process. Today's hearing comes at a crucial time for the community banking industry, and I applaud the chairman and the members of the committee for your focus on this crucial sector. Without collective action from Congress and the federal banking agencies, we will continue to lose community banks at an alarming rate, and the communities that depend on their financial services will struggle to find suitable alternatives. Working together, we can establish a regulatory and supervisory environment that allows the cornerstone of this industry to not just survive, but thrive. Thank you.
Thank you, Commissioner. Ms. Owen, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for this opportunity to testify at today's hearing, Making Community Banking Great Again. First, I want to thank Chairman French Hill. Not only is he a dedicated husband, father, and public servant, he is also a dear friend. I have known him for over 50 years. His deep understanding of financial services and tenured bank experience is invaluable as he leads the committee. I also want to thank each of you in serving on the House Financial Services Committee, as you have an exceptionally important job ahead of you. I fear community banking has never been more difficult than it is today. And just as so many community bankers are striving to serve their customers and communities, many are also struggling to survive. We desperately need your help to address the overwhelming regulatory burden we face. I know you are the people we need to get the job done, and offer my thanks in advance for your support of the chairman as he works to make community banks great again. My name is Cathy Owen. I'm Chair, President, and CEO of State Holding Company and Executive Chair of Eagle Bank and Trust Company, a $490 million community bank in Central Arkansas with a rich 100-plus year history of serving its customers and communities. Last year, I celebrated 50 years in banking, having started my career as a shred clerk when I was a teenager. In addition to running our bank, I am currently Vice Chair of the American Bankers Association. I've chaired the ABA's Government Relations Council and the the Arkansas Bankers Association. And I'm also very involved in advocacy efforts on behalf of America's banks. I'm also a mother, a wife, and a grandmother. In preparing for this hearing, I asked our compliance team to provide real-world examples of unnecessary and counterproductive regulatory red tape. Although well-intended, the CFPB's final rule on Section 1071 presents both a tremendous compliance burden on lenders and privacy concerns for small business loan applicants, and we strongly support congressional action to overturn it. The lack of transparency and accountability at the CFPB is taking a heavy toll on America's banking industry and the millions of customers we serve. Replacing the sole director with a 5-member bipartisan commission and placing the CFPB under congressional appropriations process would introduce sorely needed accountability to the Bureau. We want to comply with CRA and serve our communities, but there are vast gray areas left up to interpretation by both regulators and the bankers. CRA should be reformed to clearly tell us what we need to do and what format and documentation is required. Just before the end of 2024, our bank grew suddenly to over $500 million in assets. Regulators informed us to comply with the new FDIC Improvement Act requirements by year end, meaning we had only 2 weeks to comply. which was impossible. Instead, we chose to shrink the bank by moving deposits of customers out of the bank. If asset thresholds are imposed on the industry, they should be indexed to inflation. Borrowers constantly complain about the required waiting periods for receiving the closing disclosures in Truth in Lending Act's TRID rules when waiting an additional 3 to 6 days for actually closing and receiving their funds. This unnecessary red tape should be eliminated. In my written testimony, I mentioned several bills that we support. One of those bills that I think is important is the Promoting New Bank Formation Act. This would promote increased availability of banking and financial services for local communities by helping to create new de novo banks. Finally, combating fraud is a critical issue for our banks and customers. Congress and the regulatory agencies should pursue an all-of-government approach to combating fraud to reduce the number of Americans who fall victims to scams. In conclusion, at Eagle Bank and Trust, we have a long history of service to our local communities in Arkansas, and our commitment to community development loans and investments is shared by the thousands of community banks across the country. Many of these banks are under pressure to survive due to regulatory overreach and unfair competition. We support your ambitious agenda to provide needed regulatory relief for community banks and hope you will consider the many ideas presented in this testimony and ABA's Blueprint for Growth. Thank you once again.
Thank you, Ms. Owen. Ms. Rainey, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, my name is Rebecca Romero Rainey, and I am President and CEO of the Independent Community Bankers of America. I testify today on behalf of thousands of community banks across the country in rural, urban, and suburban markets. Before joining ICBA, I was chairman and CEO of Sentinel Bank, a $415 million bank and minority depository institution, or MDI, headquartered in Taos, New Mexico, and I'm a proud third-generation community banker. Sentinel was founded by my grandfather, Eliu Romero, in 1969. Years earlier, he had been denied a loan to finance a new law practice. That experience led him to start a bank that would provide credit for all in his community. And I'm proud to carry on his legacy, first at Sentinel and now at ICBA. Thank you so much for convening today's hearing on making community banking great again. I'm delighted that we share a commitment to a future of great community banks to promote American prosperity. And I would like to say a few words about what makes community banks great. We have deep roots in the communities we serve. More than 1,000 community banks are more than 100 years old and have survived historic, systemic shocks, standing by their customers in catastrophic times. Others are de novo charters poised for growth, and we need more of those. In a community bank, local deposits are reinvested back into local credit. The business model is the purest form of economic development that there is. We often serve communities overlooked by larger, out-of-market institutions and offer customized products and personalized services to suit the unique needs of our customers. Community banks are responsible for a disproportionate number of Main Street small business loans, especially in smaller communities, and some 70% of bank agricultural loans. In 1 in 3 U.S. counties, community banks are the only on-the-ground banking option. Whether historic or de novo, community banks are modernizing and embracing innovation and new technologies to reach more customers and small businesses. Responsible innovation is our motto. I want to thank Chairman Hill for crafting a set of banking principles to guide policymaking in the new Congress. There is strong overlap between those principles and ICBA's agenda for the new Congress, which has been endorsed by all 44 of our state affiliates and is attached to my written testimony. As we enter 2025, top of mind for community bankers and small business borrowers is the impending implementation of Section 1071 of the Dodd-Frank Act. The intrusive data collection required under 1071 will compromise the privacy of small business applicants and effectively commoditize small business lending and increase the cost of credit. ICBA strongly supports Congressman Roger Williams' 1071 Repeal to Protect Small Business Lending Act. Short of full statutory repeal, the law would be significantly improved by Chairman Hill's Small Lender Act, which would provide community banks and small businesses with critical relief to support ongoing credit and community growth. To enhance the future of community banking, we need more de novo formation. Congressman Barr's Promoting New Bank Formation Act would promote the creation of de novos, especially in rural areas, by providing more regulatory, capital, and lending flexibility for those banks. Chairman Hill's principles also include changes to resolution policy that would help ensure that failing banks are not purchased by the largest banks, thereby exacerbating industry consolidation, and waiver of the least cost resolution if the FDIC finds that a transaction would increase competition and facilitate economic growth. And examination reform that would create independent review and better transparency and accountability. The exam cycle would also be increased from 12 to 18 months for more well-rated, highly capitalized community banks. In addition, ICBA's agenda calls for measures to promote and strengthen our CDFI and MDI members, curb the sale of trigger leads that compromise consumer privacy and create a flood of unwanted solicitations and confusion for customers, and address the surging problem of check fraud, among other provisions. I urge you to review my written statement for our full agenda for a more detailed discussion of these and other important provisions. Let me close by again invoking my grandfather, Eliu. I seriously doubt he could have formed Sentinel in today's excessive regulatory and de novo environment. In fact, it would have been impossible. This should serve as a historical benchmark for the reforms we made to make community banking even greater.
Gentlewoman yields. Ms. Spotzer, you're recognized for 5 minutes, and welcome.
Thank you so much. Good morning, Chairman Hill, Ranking Member Waters, and members of the committee. Over the weekend, I had a moment to really think about the title of this hearing and ultimately what we were talking about in making community banking great again. And it occurred to me that the way to make community banking great again, if it isn't already great, is to put communities first. And so what I'd like to talk to you about today in this short amount of time that I have are policies that put communities first and relationship banking and the people that financial institutions serve, and policies that undermine the relationships that community bankers are designed to reinforce and build. So let's start with community relationships or community policies that actually help banking and help people. Those are policies that level the playing field between banking depository institutions and non-depository institutions. Because one of the biggest challenges that banks are facing right now is the encroachment of other lenders who are not abiding by the same regulatory obligations. By stepping in and holding those institutions accountable, making them abide by disclosures to consumers, and allowing consumers the information to make informed decisions about what is the best product, we can elevate community banks and help consumers make strong financial decisions that keep them financially secure. Another way that we can actually put communities first by developing a community banking agenda is by actually increasing the amount of funding that we allocate to the institutions who are doing that work. And that includes CDFIs, enforcing the work that they do, as well as the technical assistance that they provide to so many small businesses across the United States is essential for us reinforcing the notion that our lending relationships as community bankers drive small business. Finally, another thing that we can do to stimulate community banking and put communities first in the process is seriously consider proposals that are designed to increase resources for small businesses by raising their deposit insurance cap and making those institutions feel more comfortable. So I would encourage us as a group to actually think about those types of policies and their direct benefit in not only helping and assisting community financial institutions, but also assisting the consumers that they serve. Now, there are a number of other policies, and unfortunately, some of them are being considered in connection with this hearing that I don't think actually put communities first. And one of those policies I have to be very clear about is the overemphasis on deregulation. It wasn't that long ago that we can all remember the 2008 financial crisis. But what we sometimes don't talk about in the midst of talking about regulatory burden is what led to that crisis. And the reality is that it was a series of deregulation, a lack of emphasis on oversight, that, and particularly as it relates to larger financial institutions, that led to the financial crisis. And community banks, even though they engaged in sound banking practices, were forced to feel the consequences due to the economic downturn and impact that it had on consumers. So deregulation is the type of policy and practice that leads to harm on a long-term basis for community banks. The other thing that leads to harm here is policies that undermine the independence and the effectiveness of the regulator that is charged with ensuring that there is a level and fair playing field for financial institutions and consumers. And that regulator is the Consumer Financial Protection Bureau. There's been a lot of conversation about what's going to happen with the CFPB, and certainly there have been changes in the leadership. I think it's true that reasonable minds can disagree as to the full impact or specific provisions with respect to the Bureau. But what reasonable minds cannot disagree with is the reality that ensuring that consumers are protected in the financial marketplace, stamping out predatory financial products, making sure that consumers have accurate information are all things that are essential for our financial marketplace to function effectively. And for those reasons, we need to pursue an agenda, a regulatory agenda and a legislative agenda that puts communities first by ensuring that we have appropriate rules and regulations governing the financial marketplace. Thank you so much.
Gentlewoman yields. Thank you so much. I recognize myself for 5 minutes for questions. Commissioner Marshall, it's so good to see you. I told her when she walked in, I tremble a little bit because she used to be my regulator when I was a banker. So she still makes me nervous being in the same room. But you've served our state for over 30 years, and we've got a vibrant banking sector, and we've got some of the nation's most competitive financial institutions and successful, and I'll say big, small, investment, money management, credit union, commercial banking. So congratulations for doing a good job both as Securities Commissioner and Banking Commissioner in the state. Big responsibility. Ms. Spotzer, in her testimony I saw on page 13, asserts that there's a lack of data about small business lending in the United States, and hence her strong support for Section 1071 and Dodd-Frank's implementation, this rulemaking that we've been talking about for the last few years. Are you familiar with the call report data on small business lending, Commissioner?
Thank you for your comments, Mr. Chairman. When we look at 1071, I can assure you that as a regulator, I'm as concerned about that as the banks are. I believe that CFPB took an outsized approach to their implementation of this rule, and I applaud this group and others that in Congress, as you're going to look at 1071 and the future of it. The amount of data that is going to be required to be collected by the banks and the reporting of that data will increase and provide a significant burden on our institutions.
Could you see it driving small business lending out of the depository institution sector to the biggest banks in the country and some automated credit box, or even more so out of the regulated financial sector into the online small business lending sector? Is that possible, you think?
I agree, Mr. Chairman, because the consumer already struggles with providing the amount of information that banks are required to collect from them. They don't understand that, and the banks are struggling to collect that information. And in a small business setting, no two small business loans are alike. There's nothing that is going to make a great comparison when looking at one small business loan to the other.
Yeah.
I grew up in a family with two small businesses, and I can assure you they were very different, but our community bank served us well.
I think that's a good point. But on this point about data, I believe we collect for every depository institution in the country reports on their financial statements, loans under $100,000 and loans between $100,000 and $250,000. Is that right?
Off the top of my head, Mr. Chairman, I cannot confirm that, but I can assure you the call report data is expansive, it's growing every day, and the burden that those institutions are required for even additional documentation there is significant.
Well, because I have access to ChatGPT, I can report to you that RC-C Part 2 of the call report requires banks to report all loans under $100,000 and all loans between $100,000 and $250,000. And clearly, that is data, and it's indicative of small businesses. Cathy, Owen, sometimes I think the regulators aren't all on the same page, and the bigger the company, the more likely they're not on the same page. But in your experience, is the Fed and the FDIC and the state all on the same page on community reinvestment, or whether or not you can have a fintech partnership, or how they coordinate their exams?
We're a Fed state bank, so I can only comment on the Federal Reserve and the State Bank Department. For the large part, we're very fortunate in that our Fed region and our State Bank Department do work very closely together and coordinate closely.
Thank you. What do you think, Ms. Rainey, what do you think about that? What do you hear from your members on that? Exam coordination, and are they on exactly the same page about reviewing a fintech investment, or how the CRA should operate, the Community Reinvestment Act operate, or any other, and coordinating exams, particularly for your members that are larger and maybe subject to direct examination by the CFPB, for example?
This is something we hear a lot about, and I can tell you that there's not a lot of direct coordination and a lot of confusion in terms of what one entity might require and another, to what extent they may examine best practices, how they get rolled down to community banks. So there is not a lot of coordination today.
Mr. Kennedy, thinking about I hear a lot of comments, and I noted them, about how bank CEOs and boards of directors are thinking about the CAMELS rating, the transparency of it. And some bankers have asserted anecdotally that it's not a fair process. As a bank director, founder, lawyer, can you comment on how the CAMELS process might be reformed?
Well, as a lawyer, not specifically reference to our bank, but just in my 40-plus years of representing banks and seeing the application of CAMELS, I think your suggestions about focusing in on following the definitions and making those definitions clearer, and I think in my comments, I commented on the idea that we really, instead of doing an exam on a point in time with a snapshot, but thinking more about a dynamic trend for the bank in terms of how they apply, how the regulators would apply that CAMEL rating. It's very important. Those ratings can lead to a whole lot of positive or negative things. So I think that's a very important matter to cover.
Thank you very much, and thank the panel. I now recognize the ranking member, the gentlewoman from California, for 5 minutes of questions.
Thank you very much, Mr. Chairman. Ms. Spotzer, welcome back. It's so nice to have a former staffer testify before our committee. Good to see you.
Thank you, ma'am.
Today, Democrats will offer the types of bills our committee should be considering. If we're going to do reform, it's just not about getting rid of regulations. We should be considered bills that lower costs for families and small businesses and protect community banks and credit unions. For example, I have a bill that would halt all Trump import tax increases and his dumb trade war until we know that small businesses and the community banks won't be harmed. I have another bill that rejects co-president Musk's efforts to end deposit insurance and the FDIC. These bills will ensure there's a future for community banks. And so, Ms. Spotzer, as I explained in my opening statement, I'm deeply troubled by Trump's and the unelected billionaire Musk's early actions, including their effort to pause all kinds of federal financial assistance. Would you discuss, you have done that somewhat, but would you continue to discuss how these efforts would hurt individuals and small banks, and how they would undermine the community lenders they prefer to bank with? For example, if loans back by the Federal Housing Administration and Small Business Administration were no longer available, would that make it harder for banks and credit unions to provide mortgage and small business lending?
It certainly would. And one of the things that I would like to point out is not too long ago, I actually received a telephone call from one of our colleagues at another organization who had received a message basically indicating that they would no longer be able to actively work in providing technical assistance to small businesses as a result of the funding freeze and a series of executive orders. I think these types of policies directly impact our ability to do what we do best as community bankers, right? Which is spur small businesses, give them the resources that they need to scale. And so as we go forward, we have to think about making a conscious decision to pursue policies that empower businesses rather than hurt them.
Thank you. The Trump administration even included interest payments on our national debt in a list of programs. They may be paused before a court blocked their freeze. If we were to default on our debt, wouldn't that trigger a broad economic crisis that would harm community banks, credit unions, and their customers?
It certainly sounds like it would. Yes, ma'am.
Thank you. And what will happen when Trump's new import taxes are imposed on a bank? And this could happen in a month. Will that raise the cost of groceries and gas for consumers? What about farmers who export their crops? Will they be harmed when our neighbors respond by taxing American exports? Would all of this make it harder for community bank customers to repay their loans?
Yes, ma'am. I think the broader question here is exactly what you're saying. All of these decisions have an impact on the wallets of Americans. And as a result of that, it creates pressure for them to actually continue to pay their debts. And that has an implication for every financial institution.
Thank you. Now, if we care about community banks and credit unions, Congress must not turn a blind eye to all the harm Trump is trying to inflict on working families, small businesses, community financial institutions, and our economy. Again, Mr. Chairman and members, we support community banks, and both sides of the aisle do, but it's not going to be simply getting rid of regulations that we've worked so hard to put in place so that we could protect community banks. And so I think it's important for us to look at some of these executive orders and what they're doing, the possible harm that they may cause our community banks. And so that's what our members are going to do today. We're just going to be very open about what we understand is being done because we all want to protect our community banks. We don't want to undermine them at this important time in the history of the changes that are being made in this country. I yield back the balance of my time.
Gentlelady's time has expired. I now recognize myself for 5 minutes. Ms. Romero Rainey, you testified this morning that when banks fail, a speedy resolution is critical, which fully agree with, and you had said that the FDIC should not, quote, pick winners and losers. I would contend, and many of us over here who lived through what happened with SVB and a few other recent bank failures, is that they were lacking in that area. They did, in fact, pick winners and losers, and we saw that scenario play out. And not only was former FDIC Chair Marty Gruenberg slow to react to the failures of Silicon Valley Bank, we heard that as chair of the Oversight and Investigations Committee, we heard that time and time and time again from people who were involved in it, both Silicon Valley Bank and Signature Bank. When it came to the First Republic, he allowed their assets to be purchased by a large U.S. bank rather than rather than putting it out for bid and really having a reinforcement of the competitive nature of the banking landscape. And I want to know, are there ways that you think the FDIC specifically could improve the bidding process that would include everybody, in that failed bank assets when those unfortunate occurrences happen?
Yes, and I appreciate the question. I think there's many ways for us to examine what is required under least cost resolution that in time of a failure would ensure that, one, we're not simply allowing the largest banks in this country to grow even larger, that we're taking into account the unique needs of the communities and the customers they serve, and looking at the concept of least cost resolution to be defined over a period of time, not in just that singular moment. So this is something we would welcome engagement with the committee on.
Do you believe community banks have the ability, and are they in a position to absorb the assets of banks like this?
Absolutely. And I think as we reflect on these situations, there were many examples of smaller banks that were willing to bid, that again, if there were more flexibility and a willingness to look at least cost over, again, an extended period of time, multiple banks with unique ties to those communities could have stepped up to the plate and ensured a better resolution for those customers.
In 2018, this committee passed, on a bipartisan basis actually, some relief to those community banks. And yet we still have some who are saying that we need to regulate you all as we would a large SIFI bank or other large banks. Can you help the committee understand how Congress can build on the tailoring requirements that were as part of Senate Bill 2155 back 6-7 years ago, and how it helped revitalize the banking sector?
Tailoring is critical for a viable future where community banks thrive.
And that's because they're just different risk profiles?
They're different risk profiles. And the concept one size fits all is not what we need when it comes to bank regulation. The risk model that is a community bank is succinctly different from those of the largest
So
banks.
some want to call that rolling back. Others would call that maybe common sense application, right? If you have different type of animal that we're dealing with, it's appropriate to then have different regulations on them, correct?
That's correct. For a smaller community bank that's focused on ensuring the success of that community thrives, that risk profile is going to look completely different, again, from the larger institutions.
Ms. Marshall, I want to turn to you here. In a recently released survey of the Conference of State Banking Supervisors, community banks listed regulations as one of their chief external risks. Is that what you're seeing in Arkansas and among your other colleagues?
Yes, sir, absolutely. And I appreciate the point to the sentiment index survey that in our community bank survey where regulatory burden is highlighted as one of the #1 risk facing institutions. And when I go out and visit with my banks, whether it's in Western Arkansas or Eastern Arkansas or my colleagues across this country, I can assure you that is top of mind for them.
So I think I know the answer to this, but you wouldn't say that Senate Bill 2155 actually caused these previously mentioned banks to fail?
No, sir.
Okay, I didn't think so. Just wanted to make sure we were on the same page here. Ms. Marshall, Ms. Owen, I want to follow up on comments from Chair Hill about de novo banking. My home state of Michigan, we currently have 79 chartered banks, which is down from 86 just a year ago. That represents nearly 2,000 branches, 50,000 employees, and $314 billion in customer deposits. Ms. Marshall, your testimony highlighted just how hard it is to form a new bank. I'm hearing that same message from back home. So what can we do, the consequences, what's going to be the consequences? My time is expiring, but very quickly.
I think the message around tailoring is appropriate and getting from process-driven examinations.
Great, thank you. And I know we have a title of making community banking great again, but ultimately it's all of our goal to make sure that credit is available and through access, whether it's credit unions, you all, those are those communities that really where the rubber hits the road. So with that, I recognize the gentleman from California, Mr. Sherman, who is recognized for 5 minutes and 30 seconds.
Thank you. I want to thank the ranking member for focusing on how disruption disrupts our entire economy and hurts every private sector decision maker. The ranking member points out that this administration was toying with the idea of, well, maybe we just won't make payments on our national debt. How is somebody supposed to do business and take all the risks involved in being in the private sector? How we have a 25% tariff on Canada, then we don't, then we might, then it depends on whether their prime minister says something nice about how our president looks. how is a community bank, and this is just a rhetorical question, supposed to decide whether to make a loan to a business when they don't know whether they're going to lose all their Canadian and Mexican sales next month? It's just throw, a wrecking ball at everything in our economy, gets good ratings, dominates the news cycle. I'd think it's hard to say that being a community banker is great when you have to deal with that. We got to make banking great, not just for the bankers and the community bankers, but for the consumers. So for God's sakes, we cannot abolish the CFPB. They produce $21 billion for consumers. We're going to save $6.1 billion on overdraft fees. The way to make a banking great is not to leave consumers without protection. Another thing that wasn't so great about banking a couple years ago was the collapse of several banks, including Signature Bank, where we're told that one of the factors was that the FDIC was understaffed. Now we're told that they're still understaffed, they don't have enough bank examiners, but 200 bank examiners who had offers are now seeing those offers pulled. Now those that barely qualified might wait around to see, but the ones with their most qualifications, the ones that are wanted by the private sector, they've got other jobs by the end of next week. So they're gone. But we also see the FDIC being told, if you work for the FDIC, hey, you can get 8 months' pay for quitting your job. Well, who's going to quit? The people who can easily get an even better job in the private sector. So we lose our best and our brightest. I'll ask Ms. Spoxer, if the FDIC is unable to prevent future bank failures, is that bad for the image of community banks and their ability to attract depositors?
It certainly is.
I thought that was an easy question. Now, community banks make mortgage loans. They can't afford to hold those loans on their balance sheet. They sell them to Fannie and Freddie. If we abolish Fannie and Freddie, is that good for community banks? Yes.
No, not at all.
So that would, okay. So then we have a law in Florida, which I hope this committee would see fit to preempt, that says anytime you're turned down for a loan in Florida, you can say, well, that's because of my political beliefs, and you start a state investigation. Is that good for community banks?
I'm not familiar with the law, sir, but it doesn't sound like it's good.
And it creates a circumstance where the federal law says that you'd better not reveal the fact that you filed a suspicious activity report, but the Florida law says you have to explain why you didn't want to do business with somebody who was suspicious. So you're in a conundrum where you're forced to do something by state law, prohibited doing something for federal law. Does that make community banking great?
It certainly creates compliance challenges.
Okay. And then we have rules that apply. Let's just say we still have a CFPB. There are those who say, well, we'll impose those rules on loans made in dollars, but we'll exempt crypto. Since banks have their deal with dollars, all of them I know, if they're at a competitive disadvantage for the crypto industry, does that make community banking great?
No, sir.
I yield back.
Gentleman has 6 seconds. Gentleman yields back. So with that, gentleman from Oklahoma, Mr. Lucas is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all of our witnesses for testifying today. Community banks are the heartbeat of local communities, and my district is agriculture, it's energy, it's Main Street. and community bankers uniquely address the needs of those capital-intensive industries like the ones in my home state. And before Ms. Owen, before I start my first question with you, I'd just like to offer an observation. My first banker was an older banker at the time. He'd been my father's banker, he'd been both of my grandfather's banker, and as a very young banker, he'd banked two of my great-grandfathers. So community banking and those relationships are important to me, having lived it firsthand. So, Ms. Owens, what does it mean? And I know this is, just simply say this is a hearing about stressing the importance. What does it mean for the local community when community banks are able to thrive in communities like mine and many across the country?
It's huge to the communities, the customers. If a community bank can't thrive, then we can't serve that community. We can't buy the school uniforms. We can't supply food for the food pantries. We can't provide the financial education. We can't make the loans that are necessary for those communities.
Turning to you, Ms. Romero, Rainey, the chairman and the vice chairman have discussed how in 2018 Congress rolled back some regulatory burdens placed on community banks. Could you expand from your perspective what other areas of focus does Congress need to consider to build on that progress?
Certainly, I think as we build on that progress of creating again, not a one-size-fits-all path to regulation, whether we're talking about the exam environment in which community banks operate and how we allow for more flexibility for well-capitalized and well-managed institutions. I think another significant opportunity is how we think about de novo banking. Again, the one-size-fits-all charter for a community in Oklahoma does not look the same like it does in downtown New York City, and we need to think about it differently in terms of what regulation should be required and how we appropriately give flexibility. And that's what we're looking for is as we serve unique communities of all shapes and sizes across this country, we need that flexibility. It's not about, it's about enforcing and creating more approach to safety and soundness, but giving us the flexibility to manage within that.
Ms. Marshall, we've seen a dramatic decrease in the number of new banks created in the last 20 years, as my colleagues have noted. And I have listened personally to investors talk about at different times in the last 20 years where the regulators were so focused on making people take problem banks that they wouldn't allow, wouldn't encourage new charters, de novos, until that was taken care of. What are some of the challenges that you see in entering the market, and what should the government do to consider incentivizing new bank formation?
Yes, sir, and Arkansas is no different. We've only seen in 20 years, we have not seen a new de novo bank application, and that's a trend I'd like to see change, not just for my state, but across the country. But I believe we need to focus on ensuring those interested parties that our industry is open for business. We need to focus on and reminding them that the regulatory burden is manageable, and we can do that through the tailoring, as I've mentioned before. We need to spend this time and take this opportunity to review static thresholds that have, quite frankly, not been indexed or reviewed in quite some time, because $10 billion today is not what it was when some of those thresholds were put in place. And I allude that to the Bank Secrecy Act or other thresholds within the regulatory environment. We also need to ensure that we have healthy entrants into the marketplace, and we also have that opportunity for exits through M&A activity, and no barriers to that for local-to-local bank mergers.
Well, I just want to say that access to capital is a hugely important topic in districts and with the kind of industries I have back in Oklahoma, and I look forward to working with my colleagues on the committee and the new administration to addressing these issues that we've highlighted today. I think of my first old banker who was a multi-generation banker, and he had his institution open 5.5 days a week. And on Saturday afternoon, when he closed at noon, he'd get in his pickup and he would drive around the county looking at your farm, looking at your field, looking at your business, doing a personal eye assessment of what was going on. He survived the Great Depression. He survived the drought of the 50s. He survived the meltdown of the 1980s. I have the greatest of respect for that kind of community banker. Yield back.
Gentleman's time has expired. With that, the gentleman from Georgia, Mr. Scott, is now recognized for 5 minutes.
Thank you, Chairman. Ms. Sponsor, thank you for your excellent and well-delivered testimony. I learned a lot. Most importantly, put communities first. You're absolutely right. And our banking system is much like the heart in the body. It pumps the blood throughout. Our banks do the same thing. That's what pumps our money, our lending out. It is the basis. Now, Ms. Sponsor, yesterday, the former CEO of Silicon Valley Bank, Mr. Ken Wilcox, warned that President Trump's deregulation agenda could lead to more bank failures similar to those experienced by Silicon Valley and others in 2023. And worst of all, Mr. Wilcox said this. He said that we could potentially see failures like those seen during the 2008 financial crisis because of loosened regulatory enforcement. Now tell us, do you agree with Mr. Wilcox's statement? And where do you see President Trump's banking deregulation agenda causing the most damage?
Thank you for that question, sir. One of the most fascinating things is that we're at a time where Americans across the country are already facing financial hardship. We see that because we see that people are more likely to pay just the minimum due on their credit cards. We see that when we hear consumers talk about the fact that they are struggling to buy groceries. Any act that makes it more expensive to access credit, and any act that does that by virtue of, quite candidly, a policy that pursues deregulation but allows, as a result of deregulation, for consumers to experience paying more, what we've called in the past, junk fees, is a policy that actually will, on a long-term basis, hurt us all.
And going to your point about putting the communities first, excuse me. I have a slight cold. Ms. Sponsor, in your opinion, what happens when the people in the community who are advocating for caution, who are advocating for soundness, are not even involved in the decision-making process about such a critical area?
Well, I think we all suffer, and I think that we've heard from all of the witnesses on the panel, the thing that makes community banking so important and relevant is that it is relationship-based. It involves people actually listening, or institutions actually listening to their customers and hearing their concerns as well as their desires to build. And if it is relationship-based banking and that is what makes it important, then obviously it's critical to pay attention to the concerns that are raised by communities.
And how is this environment exacerbated, specifically speaking about community banks?
Well, I mean, we've heard a bunch of the conversations about the challenges. With larger financial institutions as well as non-banking, non-depository institutions not being held accountable to the same standards, it creates a situation where community banks can be less competitive. And that is one of the biggest challenges here. I think that the ways to increase the competitiveness, of community banks has something to do with giving them opportunities to expand their competitiveness by For example, increasing the amount of deposit cap that relates to small businesses, providing increased technical assistance and opportunities, allowing them more access to technology, as we talked about before, and making that affordable to them. It's not to say that we don't believe in the notion that regulation should be tailored. What we are saying is that we already acknowledge that regulations have been tailored and that many of the rules that people have pointed to as creating regulatory burden, in fact, do not apply to community banks in the United States.
Thank you, Ms. Spotzer. I appreciate that.
Gentleman's time has expired. With that, the gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank the Vice Chair and I thank the Chairman for organizing this inaugural hearing of the 119th Congress on community banks, local institutions that provide absolutely essential banking services for communities across my home state of Missouri and the nation. 90% of the banks in my district are community banks, and they are often the main source of funding for small businesses and farmers throughout Missouri's 2nd District. After the passage of Dodd-Frank, community banks were forced to contend with complex, overly prescriptive, and burdensome suite of regulations. I don't think there are any junk fees. I think there are junk regulations imposed, if you want my humble opinion, but that made basic financial services less accessible to small businesses and middle-income Americans. The bills we are examining today will give local banks much-needed relief from these one-size-fits-all regulations, allowing them to better serve and meet the needs of local businesses, which will lead to investment and economic growth in Missouri and across the country. Ms. Rainey, the Vice Chair and others have touched on this. You noted that after Dodd-Frank passed, de novo charters, which allow for the formation of new banks, I don't know why we just don't say that, de novo, I mean, whatever, dropped from an average of 170 per year to just a handful. This sharp drop in new banking opportunities is depriving communities of access to banking and local credit, especially in rural areas. Ms. Rainey, what reforms can Congress and/or regulators make to reverse this trend and encourage more de novo formation, new banks, new community banks?
Thank you for the question. And yes, as the chairman noted earlier, we've only had 82 new banks formed since 2010, and that's not enough. And so there's so much that can be done here. And I really draw your attention to the minimum capital requirements, especially as you look at smaller, more rural areas. We need a proportionate connection to how much capital is required to what is the business that we're going to do. And we look at it more, again, from a one-size-fits-all. So period of time, so a base minimum capital requirements, and then a period of time for them to grow that capital to, again, allow for that flexibility and take into account the unique needs within that community.
Thank you. I think there's that and minimum capital requirements and much more that needs to be addressed. In 2020, based on robust data collection and analysis and an extensive public comment period, the FDIC crafted a new rule governing brokered deposits that allowed financial institutions to access diverse funding sources and gave consumers more control over their financial decisions. Yet, late in the previous administration, Chairman Gruenberg attempted to rush through a rule returning brokered deposit governance to the pre-2020 status quo without conducting analyses to justify the change, and in fact, seeking to collect data from banks on the characteristics of their brokered deposits. Are you ready for this? After the proposed rule. After many of my colleagues and I joined Financial Institutions Subcommittee Chair Andy Barr, in urging the FDIC to reverse course, I was glad to see FDIC Acting Chairman Travis Hill withdraw this very poorly crafted rule on January the 21st. Ms. Marshall, can you discuss how community banks use brokered deposits to access funding which allows them to make more loans to small businesses and to families?
Yes, ma'am. Thank you for the question. Deposit competition is greater now for our community banks than ever before. They are being forced to look at all of the tools and resources that are available and have a broad playbook of funding sources to be able to meet those demands and needs for their customers and those loan opportunities. You need to be able for a community bank to use broker deposits, rely on core funding, have access and utilization of wholesale activities such as Federal Home Loan Bank System or the Federal Reserve discount window, and all of those things in measure with appropriate parameters make for a holistic and appropriate funding structure for community banks to operate under. And community banks have used broker deposits successfully for a long time. They need to be able to continue to do so.
Yeah, my time is expiring here, but Mr. Kennedy, I do have 2 questions for you, and I'm going to submit them for the record, and I yield back to the chair.
Great. And that's a good reminder to all the members. If you have questions that you are not able to get to for the panelists, please direct the inquiry through the chair, which we will get to the panelists, and then we would request that you would, in very short order, reply to those. So we appreciate that. And sticking with our Missouri theme, we are going to go now to the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you very much, Mr. Chairman. Ms. Rainey, thank you for being here. Thank all of you for coming today. There's a great deal of discussion, maybe even accusations as it relates to diversity, equity, and inclusion. Are small banks, community banks, particularly in rural areas, is it important to have balloon notes on a mortgage?
Is it important to have balloon notes? Is that what I heard? I'm sorry. Yes. So balloon notes provide some level of flexibility for those community banks that desire to keep that mortgage loan on their balance sheet but are unable to take the interest rate risk over a 30-year period of time. So yes, in some cases, that is part of their model to do balloon notes.
And if we, Congress unconsciously halt balloon notes, would that be like intentionally trying to hurt small banks, community banks?
Yes, by removing the ability for community banks to offer balloon notes, that would hamper their ability to serve the customers and to provide that level of service in their community.
Yeah, I agree with you, 100%. But the issue is, if members of this committee approve some legislation that would in fact eliminate it, would it mean that the members here are just mean people discriminating against small community banks?
No, I don't believe that's what it would mean. I think it's just a limitation of the services.
I agree with you. So if people make decisions, even unconsciously, that exclude people, should not that be addressed, or to exclude people or communities?
Yes, so if groups are excluded, that should be addressed. And that's one of the things I love about community banks, is because they're so close to the community, they are able to understand what those unique needs and those relationships allow them to serve. It's why our bank was founded, is trying to serve everyone in the community.
I don't disagree with you. The point I'm making is that sometimes people are exclusionary in their practices, things they do unconsciously. That there's no intentionality, we're just going to do something. For example, I had a little town in my congressional district, and they wanted to apply for some community development block grant monies. Well, they can't do it because you have to have 50,000 people to get what's called, a entitlement grant. And so little small communities can't get it. They have to compete with, 200 other little towns. And in this little town, I'm talking about the mayor's office was in the grocery store. So they have no grant writers. And if that is required, and it is right now, are we trying to discriminate against them? Anybody? Yeah, we're discriminating. We're hurting little towns. I'm saying that. And it can be done unconsciously, which is why diversity, equity, and inclusion is important, to try to cancel that out. I mean, I'm not saying people just sit up and say, let's discriminate against people of color and women. But if you design things unconsciously, you can hurt them. And so what you need to do is try to figure out, what can we do to stop that hurt that may even be unintentional? Diversity, equity, and inclusion is trying to do that. And we're saying, no, let's forget that. I am just, I don't care, but if there, what happened to a little town like Orick, Missouri, had a tornado to come through? You got to have a special kind of process to go after, to get FEMA money in a little town. Do you think people sat up in here and said, let's try to figure out how to hurt little towns after a devastating tornado? My time is running out. I hope you got my point. I yield back, Madam, Mr. Chairman.
Gentleman yields back, and the gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Mr. Chairman. A major problem that has prevented new bank formation in our country over the last few decades is burdensome initial capital requirements, often as high as $30 million when all is said and done. These requirements leave the organizers of a new financial institution with a razor-thin margin of error in executing its business strategy and generating a profit. And that's why we've seen a dearth of new banks and de novo charters in our country over the last decade or so. And that's why I've reintroduced my Promoting New Bank Formation Act, which would establish a 3-year phase-in period for new banks to comply with federal capital requirements and the community bank leverage ratio. Mrs. Romero, Rainey, can you discuss how giving startup banks more time and flexibility to meet these initial regulatory requirements could foster de novo bank formation in rural and urban communities throughout the country? And I would ask you to direct your testimony to my colleagues on the other side of the aisle, including Mr. Vargas and Ranking Member Waters, who have expressed interest in working with me on this issue.
Thank you. I appreciate your long work and engagement in this issue. When we think about new charter formation, as we've discussed here today, the first step is that capital requirement. As I mentioned in my opening statement, my grandfather started a bank with $300,000. There's no way that would happen today, and that's what I'm advocating for. But those base level capital requirements need to be reflective of the size of the community and the business model that that bank would represent. Not only those opening business requirements and capital requirements, but also the business plan over time to allow that flexibility to engage in the business of banking, to retain that local community capital so that it can be deployed in the form of loans and create that source of economic development that is so lacking in so many of our rural communities.
Well, thank you for that. And let me ask a question about 1071 also. The Kentucky Bankers Association created a simple questionnaire explaining the statutory requirement for financial institutions to collect data pursuant to Section 1071 Small Business Data Collection Rule. This questionnaire would allow the customer to fully understand why the data is being collected, removing any uncertainty from the client and easing the potential litigation on the bank. I know there's concerns about another mandate in the final rule that a bank's low response rate may indicate noncompliance, but generally, Ms. Owen, do you think a questionnaire like this would help provide more certainty for your clients? And could it ease liability concerns for your institution?
The questionnaire could certainly help explain more, better define the information that's being requested to the customer. I really can't respond on the liability concerns because I don't know how the regulators will look at it when they analyze the information. And if the customers choose not to disclose and there's few responses, if we'll be forced still to go ahead and comply.
But the data collection requirement under the final rule is pretty burdensome. Would you agree with that?
Very burdensome.
Yeah, burdensome, and I worry that it would force many small banks to exit small business lending altogether. That doesn't help minority-owned small businesses, does it?
Not at all. Most of them have a very difficult time gathering the information that's needed to comply with various regulations.
And one thing that I'll recall from our conversations and debates with the ranking member and other members on the other side of the aisle on 1071 was that they, in addition to Director Chopra, said that this was voluntary. And so if it's voluntary, if it's truly voluntary for these small businesses to provide this data, we want a questionnaire so that they can actually choose whether or not it would be burdensome for them to supply the information or not. Mr. Kennedy, let me shift back to broker deposits following up from Congresswoman Wagner's good line of questioning. How did the uncertainty generated by Chair Gruenberg's push to overturn the 2020 broker deposits rule harm your institutions and customers?
Well, if you ask me the bigger question, really, I get to it, is that frankly, I think that the term broker deposits should just go away. It was really instituted in 1989 to address an ill where banks were buying broker deposits, and we just simply don't have that anymore. We have responsible deposit networks that community banks like ours and many of our clients use to provide federal deposit insurance to customers and institutions in those communities.
My time is expiring, but bottom line, Mr. Kennedy, did the 2020 rule, the previous rule, did it improve community banks' access to diverse funding streams?
Yes, it did.
Great. I yield back. Thank you so much.
Gentleman yields back. I now call the gentleman from the great state of Illinois, Mr. Foster, is now recognized for 5 minutes.
Thank you, Mr. Chair. I'd mentioned my very positive experience with banks of all sizes during the time our business was growing. And I'd like to focus the work of this committee on what we can actually do to help. And we have to, the starting point of that has to have a clear-eyed view of what the real situation is. There's an interesting set of articles in the Wall Street Journal from the last couple of years that looked at the stress in small community banks, and much of it is simply the result of fundamental economic forces that we have to recognize, and if we need to subsidize the existence of small banks, we may have to do it explicitly. Because these are real forces, simply the lack of economies of scale, which is very important in the increasingly digital economy we have. The brutal fact that, in dying rural towns, there are not many profitable opportunities for loans. And that's just the fact. There were, in the Wall Street Journal, they talked about banks whose survival strategy was to keep branches in the tiny towns that they started in and then establish branches and simply to get deposits in those small towns and then do their actual loans in the nearby bigger city. And you understand the fundamental forces there, and we just have to understand that as well. However, we have to be careful of this narrative that all we have to do is get government out of the way and everything will be fine. Mr. Kennedy, you look like you and I have enough gray hair that we remember the savings and loan crisis, or at least its aftermath. That's for those of members who are not familiar with it. Most of the members of this committee were not in Congress during the Wall Street crisis of 2008, and I think none of us were there during the savings and loan crisis. But it was a much bigger deal. In the end, during the 2008 crisis, when we had to pass TARP, we taxpayers eventually got paid back with interest on that. So we made money on the TARP bailout. That was not the case for the savings and loan bailout, where Congress had to vote $150 billion, which corresponds to about $750 billion in GDP terms today. And and much of it, frankly, went into Texas, which caused a certain amount of stress inside Congress, and probably was a result the Super Collider was killed, which was a separate discussion. But so this was a big deal. But if you look at that, so as I say, members should just spend a few minutes on the Wikipedia article or the Investopedia article, if you prefer that, on the savings and loan crisis. Understand, this was the simultaneous failure of many, many smaller institutions caused by misguided deregulation, the elimination in some cases of capital requirements at all, causing these zombie thrifts to go and continue to get deeper in the hole. And in the end, the government the taxpayer was on the hook for about 2.5% of GDP. As I say, just a huge amount of money. And this can happen again if we don't maintain knowledge of what happened. So be careful of that, but what can we actually do to help? And one of the things that I guess Ms. Marshall mentioned was the cost of KYC compliance. And that is something where I think we can do some good. You know, there is the tool at hand for that is the Real ID compliant digital driver's license. It is completely feasible to onboard customers today by having them get out their cell phone, do their biometric login, present their Real ID NIST compliant digital driver's license, and have them prove they are who they say they are. Go hit FinCEN's or website or whatever to see, is this person on the list of bad actors? And if they come back clear, you're on board them. And I've actually discussed with the chair of the full committee the possibility of setting up a pilot program to see if this very lightweight onboarding, I think, could be a huge benefit, both for lowering the cost of KYC compliance and dealing with the fraud problems that is another huge cost for small banks. They don't have the same fraud prevention team of JP Morgan. And so that, I was just wondering if you have a reaction to that sort of proposal. Yeah.
I appreciate any opportunity for Congress to look at the BSA-AML laws that have been in place for far too long without appropriate review. I think technology and innovation in the financial services sector is going to be able to yield big results for us as both regulators in the industry and policymakers. I think we need to look at all those types of options that you've described as potential enhancements to that burdensome regulation. And it is appropriate because no one, again, wants the BSA-AML or the financial services sector to be used by criminals or for illicit activity. But that needs a fresh set of eyes after almost 50 years. I will make an additional comment to your point of fraud. It is one of the top risks, along with the regulatory burden that I speak to my institutions about, as well as cyber risk. And those three areas certainly need our attention.
Thank you. You yield back.
Gentleman yields back. I now recognize myself for 5 minutes from the great state of Texas. This past November, the American people made their message very clear. American families, small businesses, community bankers, farmers, and ranchers are all tired of burdensome regulations that hinder the financial service industry. The previous Biden administration continuously pushed policies that were out of touch and only led to higher compliance costs. And one policy in particular was the CFPB's famous Section 1071 Small Business Data Collection Rule. And I have been consistently hearing from small community bankers back in my district and across the country about how they are concerned with the complicated reporting requirements in this rule that will tie up loan officers and increase compliance costs and officers, ultimately forcing bankers to pass these costs down to their customers. Furthermore, lenders are worried this rule will push the industry towards a standardized small business loan product and kill relationship banking. This overly burdensome rule will limit the bank's lending abilities and make it harder for small businesses to access the capital they need. So yesterday, I proudly introduced the 1071 Repeal to Protect Small Business Lending Act, which repeals the 1071 Small Business Loan Data Collection requirement to help eliminate costly regulatory burdens on financial institutions. So thanks to my colleagues who signed on to this legislation, I look forward to working with Chairman Hill and the Trump administration to repeal this deeply flawed regulation. So Ms. Owens, could you elaborate on the CFPB's 1071 rule, how it will negatively impact community banks and lead to a reduction in small business lending? And additionally, how will increased compliance burden affect the ability of local lenders to provide relationship-based lending?
Yes, thank you very much for your question. No doubt for community banks, it will be a disproportionate expense to them for the implementation and training to be able to implement all 81 of the data point fields that are required with 1071, which is of great concern. I'm concerned that many community banks may not be able to afford that implementation, which then would limit and restrict their ability to loan to small businesses. I also have great concerns on the privacy issues of 1071. Since much of the information is to be released to the public, although it'll be anonymized in a small community, it won't be difficult to know which small business, grocery store, gas station, factory either was approved for a loan or declined a loan.
Thank you, Ms. Owen. And with that, I would like to submit two letters for the record from the Equipment Leasing and Finance Association and the Defense Credit Union to council supporting my legislation to repeal Section 1071. So another issue with the rulemaking agenda of the previous administration was the lack of regulatory tailoring and a one-size-fits-all approach to regulations. Because of the lack of regulatory tailoring, community banks were forced to comply with the same set of rules as our nation's largest banks, and this leads to hundreds of additional hours spent on compliance, forcing community banks to close their doors or merge to be able to meet the needs of their communities. So, Ms. Romero, Rainey, could you discuss how one-size-fits-all mandates harm similar institutions and how this regulatory approach impacts the availability of credit for small businesses and rural communities?
Yes, sir. One of the things I appreciate most about community banking is that the fact that their success depends on the success of the local community. And so when we think about regulatory burden, if it's not proportionate to the risk that that smaller institution represents, then it creates undue burden that prevents their ability to offer those customized products to meet those needs of the community. It also hampers the ability to create new banks. It also hampers the ability in terms of how they expand, how they compete competitively in terms of their technology offerings. So we have to look beyond one size fits all and ensure that we're proportionately managing the risk the institution represents.
Okay, thank you. Now, I have a short amount of time, but Ms. Marshall, can you explain how the decline in community banks and the lack of new bank formations are harming rural communities? And why is more competitive banking environment ultimately beneficial, not just for consumers, but for the banks themselves?
Thank you, sir. Yes, no two banks are alike, no two community banks are alike, and the largest institutions are not focused on operating in rural parts of this country. And so it's imperative that we have institutions that have a appropriate size, risk profile, and business model to serve those smaller areas, or those individuals will not have access to the funding sources, the lending opportunities, the deposit opportunities that they need. And it's very important that we all recognize that not everyone lives in a large city. They may not all have access to broadband. They may not also, quite frankly, not all use a cell phone. And so that local community bank with that neighborhood presence where those bankers go to church.
My time is up.
Thank you, sir.
For that. Next, the gentlewoman from the great state of Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you to our witnesses. We're here today to talk about making community banks great again. Although I think our community banks have always been great. We all value our community banks. These vital institutions provide our constituents with access to credit and other critical financial services. They create local jobs, they extend mortgages, they give loans to small businesses, and promote economic development in our communities. But it's ridiculous to be having this conversation while the President of the United States is actively taking steps to hurt our community banks and our economy. When his proposed 25% tariff on Mexico and Canada go into effect, this will have a disastrous knock-on effect for community banks. Make no mistakes here today. When you inflict financial harm on bank customers like hardworking families and small businesses, Mr. Chairman, you inflict harm on community banks. When a trade war causes small business supply costs to go up or increase the cost of exporting materials, this financial strain will make it harder for those businesses to repay the loans they receive from community banks. The same will be true for consumers paying more for gas, more for groceries, and more for a lot of other things, making it hard to keep up with their mortgage loan payments, again, to community banks. His illegal Ludicrous attempts to freeze nearly all government financial assistance programs would have impacted all kinds of bank customers. It would have undermined small businesses' support programs like the state small business credit initiatives. It would hinder CDFIs, including community banks and credit unions, from getting support from CDFI, the CDFI fund to serve small businesses and underserved communities. His radical crusade against diversity, equity, inclusion, and now accessibility will do significant damage to our economy because diversity, equity, inclusion, and accessibility is good for business, and yes, it is good for banks. Already his sweeping, senseless executive orders are creating disastrous, unintended consequences, causing federal agencies to eliminate and completely non-diversity, equity, inclusion, and accessibility-related web pages, materials, resources, and programs. Mr. Chairman, we now have an unelected, unaccountable billionaire with access to the entire federal payment system that disperses trillions of dollars in government expenditures from Social Security payments to tax refunds, creating a data privacy violation of an unprecedented attitude. Mr. Chairman, I hope that all of our colleagues on your side of the aisle are as bothered by this as I am bothered. Finally, so while I appreciate our community banks as our chairman does, and I have prepared questions for our witnesses today, I simply cannot ignore the hypocrisy of having this discussion in the face of an absolute chaos and havoc this administration is recklessly inflicting on our economy. With that said, Ms. Rainey, I'd like to direct this question to you. As we all know, financial fraud is on the rise. Bad actors are finding new and more sophisticated ways to steal customers' hard-earned money. I know that community banks are on the front line of this fight through your Know Your Customer identity verification, financial literacy program, and more. What more can regulators do to help community banks combat fraud and protect our consumer fund?
Thank you for the question, because it is a significant issue that we're seeing a dramatic increase in. Things as simple as, I like to say, back to the future check fraud, where we're seeing checks being stolen from the mail, washed, and then redeposited. So what we're looking for here is greater coordination amongst the agencies as well as financial institutions. Also working on things like coordination with the post office to make sure we can communicate and begin to tamper out fraud. But I think this is an area where coordination is going to be very helpful.
Thank you for that, Mr. Chairman. I yield back.
The gentlewoman yields. I now recognize myself for 5 minutes. First, I want to thank our chairman for choosing our first hearing to be about the community banks, which is so important to many of our communities, especially those in Georgia. That said, I think a great deal of what we discuss here can also apply to the credit unions as well, especially in the line of questioning that I'm going to have, because they face many of the same problems at the national level in terms of regulation. First, let me start off by taking us a little back into history, back to 1970, when Congress passed the Bank Secrecy Act, which, among other things, required financial institutions to report unusually large transactions to federal law enforcement. Congress did not specify what constituted unusually large at that time. Early privacy advocates challenged the law on the grounds that it violated the Fourth Amendment protected privacy, that the Fourth Amendment protects privacy rights. When it reached the Supreme Court in 1974, the court took an unprecedented step and considered the Treasury Department's rule impeding the law in their view of the law itself. They found that the $10,000 threshold was high enough and that it wouldn't capture everyday transactions. Consequently, the law was upheld. Yet, if adjusted for inflation, which it has not been, that $10,000 back then would be around $80,000 today. So, Ms. Owen, I'd like to open up with a question for you. Would you say that your bank frequently handles transactions greater than $10,000 in a single day?
Absolutely.
Probably many times over, I can imagine.
Yes.
Approximately, if you know this, approximately how much manpower goes into processing currency transaction reports at your bank?
For our small bank, we have 4 BSA officers, not to mention the tellers that are completing these transactions and the others that are checking behind them before it goes to BSA.
So the bulk portion of the reports that I can imagine are anti-money laundering, CFT compliance. How much do you think your bank spends on compliance on those each year? If you don't know, just give me a guess or an estimation.
I wish I could give you a guess or estimation. I haven't written it down or put a pencil to it. It's kind of scary to think about it. No doubt those are positions that are working on this but are not generating dollars or income for the bank.
Okay, well, let me share a little something. What the GAO found out, Government Accounting Office. In previous hearings, I've mentioned that law enforcement only issues a tiny fraction of CTR data, uses only a tiny fraction. This time, I'd like to focus on what we can do about it. And without objection, I'd like to insert a December 2024 report from GAO on this. This 110-page report states that even a small adjustment to the filing threshold from $10,000 to $30,000 would reduce the reporting burden for banks for as much as 60%. Let me just quickly read the closing note from the report. It says, by taking steps to reduce the number of unused CTRs, such as though adjusting the reporting threshold and by eliminating rarely used fields and clarifying aggregation requirements, FinCEN could reduce unnecessary filer burden without affecting CTR's usefulness to law enforcement. That's what I think we want to do, and I actually have a bill to do that, and I think it's something we can bipartisan do. So, Ms. Owen, if you had a 60% reduction in regulatory burden, would your bank be able to pass those savings on to your customers?
Absolutely. We would love to have that opportunity.
And last question for you, and I am running out of time, but as a banker, do you believe that FinCEN provides adequate feedback or follow-up once your AML compliance staff file a CTR or SAR?
Unfortunately, no. We don't receive any feedback.
Well, that's what we're hearing from a lot of small, especially small institutions and large, is that, especially with suspicious activity reports, it's very generic, very broad in definition. Since you're not getting that, does that impact your assessment of customer risk?
Absolutely. Even when we've made calls to them and tried to schedule appointments to make sure that we're submitting all the information they need on a particular item, communication would be hugely important, and I think hugely important in trying to resolve what they're trying to do.
Well, thank you, and my time has expired, and just want to thank you all for working with us as we try to make changes here. Now recognize the gentleman from Connecticut, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman, and thanks to the panel for being here. Very important topic. I watched very carefully during the pandemic the remarkable work that community banks did with the PPP. They really were life-saving for a lot of businesses, and am very conscious of the power of relationship banking. But I have two concerns. I arrived here in January of 2009 as the wreckage of the mortgage crisis smoked around us. And so I'm super conscious of efforts that are sort of ongoing and always deregulatory. And the Congress obviously has always been amenable to having tailored regulation for community and smaller banks. But I fear that the pressures associated with economies of scale on the community banks are so intense that it'll be very hard without creating risk in the system of doing a whole lot more deregulation. That's a whole other conversation, because I actually want to take the conversation in a slightly different but related direction, which is housing. We have a just shocking housing supply crisis in this country, certainly where I come from. And the multifamily business at the GSEs has been resilient and helpful to the construction, in particular, of multifamily housing. But there's only a small number, 30, I think, of lenders that are authorized to access the program. So my question, and maybe I can start with Ms. Rainey, but if we have time, we'll go to others, would really emphasizing and incentivizing community banks to be, or other small lenders, to get multifamily licenses and to access that program, would that be both a additional source of business for our community banks and maybe actually help with our housing crisis?
Yes, I think, as we think about solving for the housing crisis, it's about us creating as many opportunities and solutions as we can. So multiple points of access and various partners to work with are a tremendous part of the solution.
So why have historically, I was trying to figure this out earlier, why these 25 DUS lenders, they tend to be the big guys. Why is that true? How can we make it easier for community banks to be as involved as the big guys are in multifamily housing?
So I'm not specifically experienced with the program, but my experience would tell you that when we look at the size of transactions that we're dealing with multifamily, that may limit when you think about whether it's lending limits or concentration limits that community banks have to manage. And again, this is an area where a solution to this problem is how do we facilitate partnership and ability for community banks to work together to provide that single credit in coordination with the entity.
Any other thoughts on again, I come at this thinking that we could just deregulate ourselves into catastrophe in the very noble pursuit of trying to keep the independent and community banks alive. So my mind does go to what other sources of business are there for the smaller banks? Any other thoughts on multifamily lending from the panel? I guess not. Okay. All right. Well, thank you.
I think there's plenty.
Go ahead, sir.
I think there's plenty of opportunity. I'm frankly not familiar with that program, and I made a note. I'm going to find out about it. But I do think there's plenty of opportunities for multifamily. I mean, housing is a big issue. There's a lot of government guaranteed programs that a lot of, frankly, people just don't know about. And so as a lawyer advising community banks, that's one of the things that we like to try to do. So it's important that those kinds of programs and the agencies that are responsible for them get that word out. Can be done on a local basis and frankly, a national basis as well.
Thank you. Thank you. Appreciate that, and yield back.
Gentleman yields back. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman Hill, and I want to thank Ranking Member Waters for holding this hearing, and thank you to our witnesses for your time and commitment to be here today. I truly do believe that Chairman Hill's Making Community Banking Great Again agenda will do incredible things for banks and consumers and frankly, the greater community financial system. And I, like Chairman Hill, have experience with community banks in my state, in Tennessee, and serving with those banks and working with them. And they are very much in need of attention and relief. And so I commend the chairman for holding this hearing. Commissioner Marshall, in Tennessee, we are blessed to have, frankly, a phenomenal banking commissioner in Greg Gonzalez, who is a dear friend and a fellow alum of Tennessee Tech University. I'll put in a plug. This will be his 20th year as banking commissioner in our state in Tennessee, serving governors of both parties, and I think it's just a testament to the work that he does. One idea that Commissioner Gonzalez and I have been discussing is the concept of having state regulators, such as the Tennessee Department of Financial Institutions, conduct bank examinations for smaller community banks in place of the Federal Deposit Insurance Corporation, or FDIC. The idea here would be that for your smaller banks, than say 500 million, the state banking regulator could conduct the exam and make sure that it is sent to the FDIC. Commissioner Marshall, would you and do you believe that other state banking regulators would be willing to take part in such a proposal?
Thank you for the question. And yes, my dear friend Commissioner Gonzalez is a great regulatory partner. I will agree with you that this is an area that we need to explore because if it was enacted and something that we wanted to find, that we found good benefit from, my state, not speaking for my legislature or our governing body, but that is something that I would be interested in engaging in, and I think there are other state commissioners that would be willing to do so as well, because the smallest community banks have a very traditional risk profile. Like I said, they are often not engaging in out of territory or new market activities, but they have the ability to serve their customers. And so our one-on-one relationship with them as boots on the ground and local representative and understanding of those markets that they operate in, we have that perspective, and I think we could be able to oversee the smallest of the institutions independently, but with a good communication and coordination and collaboration with our federal partners in whatever fashion that means.
Thank you. That's good to hear. And I know that some may have concerns as to the rigor of these state banking regulator examinations. On that point, I have also considered potentially providing that staff can randomly attend certain examinations, FDIC staff, that is, could randomly attend examinations conducted by state banking regulators. Do you have any feedback on that portion of this proposal or idea?
Pardon me, if you don't mind to repeat exactly what you're...
So the idea that randomly FDIC could monitor or participate in these examinations where the state banking regulator was taking the lead?
I certainly think that as the insurance agency for our institutions and but along with us as the chartering authority, there is a role for the federal regulators to continue to play in that oversight. We do some of that right now on independent examinations. If there is a reason or a basis or a need for the federal regulatory partner to be in the room, we certainly work collaboratively with them to make that happen. But I think that that is a process that could be worked out with plenty of time to review the proposal, work together to ensure that we're on the same page, have good communication, a good framework around it, and explore those opportunities.
Thank you. Shift gears. Ms. Owen, for smaller community banks like Eagle Bank and Trust, can it be difficult navigating the process of managing both federal and state level banking examinations?
We are very fortunate in that we have a wonderful Federal Reserve region that we operate within, as well as a wonderful bank commissioner, and they work very closely together. They collaborate together. If there's a need for both of them, it's not unusual that we'll sit down and meet with both of them to get their opinions and thoughts. So we're very fortunate. I've heard from other banks that's not always the case, and it can be very difficult for other banks.
So this proposal of streamlining federal and state banking examination is one that I think could ease the regulatory burden that community banks face. To all the witnesses here today, if you have any additional thoughts on this topic, please do not hesitate to reach out to me in my office with feedback, and my time has expired. I yield back. Thank you, Chairman.
Gentleman yields back. The gentleman from Illinois is recognized for 5 minutes.
Thank you, Mr. Hill. Thank you all for being here. Ms. Owen, Sheila Bair, the former Republican FDIC chair, recently said that there is strong consumer confidence in the FDIC brand and that customers are, quote, comforted by the FDIC insured sign on their doors. Would your customers agree with that?
I think it's very important to have it on our doors, yes.
Excellent. She said that because in direct response to reports that Trump's advisors and members of this so-called Doge team are talking about ways to reform or completely eliminate the FDIC. Stay vigilant. Number two, when you get a customer who comes in who asks for a loan from your bank and you're evaluating whether or not you want to issue a loan, what the interest rates are you charge, do you look at their payment history with their other vendors, debt and otherwise?
Yes, we work up a cash flow because we want to know that they can adequately service the loan that they're applying.
And just to be clear, if they have a history of non-payment or late payment, that's going to be a negative impact on their credit score, right?
Yes.
Okay. Last week, I spent most of my time with mayors, with contractors, with businesses who had signed contracts with the federal government and were asking me whether the federal government was going to welch on that deal, whether they should demobilize construction crews that they expected to come through, whether they could count on money that was contractually obligated to them. I'm assuming that our lenders are going to be just as diligent as your bank is and say, if you're defaulting on some of your creditors, why aren't you going to default on me? At some point, that leads to an increase in treasury rates. Would higher treasury rates help or hurt the community banking industry?
That's an excellent question. I'd have to really think through it because we have short-term loans and we have long-term loans.
Sure, and we just recently saw the FDIC bail out banks that all of a sudden had a squeeze because they had higher treasury rates, right?
Correct.
This administration is not acting slowly to destroy the U.S. economy. They're acting very quickly to destroy the U.S. economy, right? Higher treasury rates are not good. Last point, question for you. In response to, in your exchange with Mr. Williams, you mentioned you had some concerns about privacy issues and making sure that information provided to regulators, doesn't leak out into the private. Would you have concerns if a bunch of teenagers who were unvetted by any security apparatus had full access to the Treasury payment system? From a privacy perspective, that is.
I'm always concerned about privacy and the protection of all of our customers and clients and all of our personal information. I'm not familiar with what you are speaking to.
Okay,
The
this
privacy,
week,
yes,
for clarity, for everybody understands, Elon Musk has put teenagers who have not been vetted, they've only been recently identified, who are controlling trillions of dollars of Treasury payments. This is confidential information, top secret information. They are going to decide who can go through and access this information. I have big privacy concerns about that. I would imagine that your customers might also have those concerns. And I can't believe that this is partisan. Look, this hearing is called Making Community Banks Great Again. I appreciate that out of deference to the majority, you all made nice comments at the start about how you also want to make community banks great again, and I share your commitment to make community banks great. I find myself questioning, when we say great again, exactly when are we referring to? Because if I look back in history and I say, when was there a point when we did not have an independent Fed? When was there a point when we didn't have an FDIC protecting runs on the banks? When was there a point when the robber barons were in charge of our government? When was there a point where the federal government refused to enforce the 13th, 14th, and 15th Amendments to the Constitution passed under Reconstruction in order to make sure that we actually honor our protection, our constitutional obligation to equal protection? And I'm going back to the 1890s. Oh, we also had really dumb tariff policies then. Any Ferris Bueller fans here? Bueller? Hawley Smoot tariffs, anyone? That was an era where we had a run on the banks, a recession darn near every 4 or 5 years. Of course, that led to the Great Depression afterwards. Is that the era we're going back to? I put this to all of you. You are all leaders in your own fields. The entire country right now is wondering whether we are going to stand up for the Constitution, for the rule of law, for making America greater than it is right now. Or are we going to stand and sit in cowardice and complicity with those who are trying to destroy it? That is a question for all of us here. And it's all of our obligation to move forward. Yield back.
Gentleman's time has expired. The gentleman from Wisconsin, the chair of the Financial Technology, Digital Assets, Artificial Intelligence Committee, Mr. Stile, Wisconsin, recognized for 5 minutes.
Thank you very much, Mr. Chairman. Before I dive into the comments, I just want to respond to my colleague across the aisle. The Federal Reserve's high interest rates is a direct response to the horrific economic policies of the Biden administration that we finally escaped from. So the massive spending, the aggressive regulatory state of the Biden administration drove inflation up. The Federal Reserve responded to that. We're now working to actually bring down inflation through addressing the regulatory burdens of the Biden administration and addressing spending. And in part, I think this is an opportunity to have a conversation about making community banks great again, in particular by right-sizing a lot of our regulations. And so let's stage set in particular on fintechs if I can. I'm going to start with you, Ms. Owens, and I'll come over to Ms. Marshall on this topic. As we know, a lot of banking is shifting into the palm of our hands. I have my iPhone here. I could jump on and do personal banking, as probably almost anybody in this room could do with their smartphone. That's a great thing. And we know some of our nation's largest banks have the ability to invest millions and millions of dollars in CapEx to develop their own proprietary apps or other tools in the fintech space. Our community banks are often relying on partnerships with fintechs. And so in particular, if I can start with you, Ms. Owens, from the perspective of a community bank, how does that partnership with fintechs work, and does that give you the ability to compete with some of our nation's largest banks for tools that consumers need?
An excellent question. Thank you very much. As a very small community bank, we have yet to partner with any fintechs. We have looked at several of them, but there is considerable amount of expense and work to make them work with our legacy systems the legacy core banking systems that we have today, which also entails a lot of additional expense.
Understood. And so as we look at this is going to be a lot about right-sizing the regulatory environment so that you can engage, knowing that there is a real cost for you to do that. So let me come to you, Ms. Marshall. When you analyze the ability of, in particular, community banks to partner with fintechs, what are the roadblocks that you're seeing in that space?
Thank you for the question. Banks need to continue to innovate effectively. They need to be able to adopt technology in other forms to be able to compete, and especially those that cannot do it themselves. And so that third-party relationship is critical and essential to that path going forward. One of the roadblocks is the fact that the guidance that's been put out thus far is not clear.
Finish your sentence.
It's not clear, it's not concise, and it could be more appropriately directed with the bank adoption in mind.
And do you think that some of the biggest and most important regulators, the Fed, the FDIC, OCC, promulgated really one-size-fits-all rules that was not scaled for community banks to be able to engage, and that they were actually dissuading community banks from engaging with fintech providers?
I agree that the current proposal, the guidelines and guidance out there is more of a one-size-fits-all approach, and I will take an extraordinary turn that I believe we need to stop using the word fintech, because that could have such a broad application of areas where there is not higher risk for a new technology that simply helps someone analyze a credit report. But if it's a technology that's going to focus in on the core banking functions, such as deposit taking, lending, payments, or custody, that has a higher risk profile and needs a very tailored approach from a regulatory perspective.
And I agree. We could have good debates on the nomenclature of fintech versus another terminology, but I completely agree with you on the importance of right-sizing the risk. I think the human mind is really good at identifying new risk when new technology comes online. It's actually not as good at identifying and determining what are the long-term benefits in ways that we can safeguard and right-size that risk. And I think what you're saying is what I have seen is that we have seen a regulatory environment where it's a one-size-fits-all approach, where they are not scaling this for our smaller community banks. And as more and more consumers are asking our community banks to be able to have the ability to navigate, whether or not it's on your phone or any other technological tool, that we really need to be pushing our regulators to be able to right-size that risk so that our smaller community banks, so Ms. Owens does not have the burden that she has, so she can partner with fintech technology, fintech players in this space to be able to provide a service that her customers are looking for. This is really important, in particular in rural America and other areas that does not have easy access to a brick and mortar facility. Appreciate you all being here. Mr. Chairman, appreciate it.
Gentleman yields back. The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to all our witnesses here today. Ms. Spotzer, I wanted to start with you. First, let me just say that I grew up in rural South Texas on a farm. So when we went into town, whether it was just to go say hello to my uncle or to do business, we always worked with community banks. Obviously, there was only 2. Now I represent Houston, where we have 33, and a lot of what you all would call big banks. But my heart is still with community banks, because they always had the little lollipops at the cashier desk for you to get. So as a child, I enjoyed that. But banks have just changed a lot, haven't they? Since the pandemic, the big banks were heavily embracing technology to make their service available to more customers. However, the community banks we have relied on for years are facing several cybersecurity risks and technology challenges as they compete with mega banks and big tech firms. And in turn, communities they represent are sometimes left behind. One of these challenges is providing services in languages other than English. According to data from the U.S. Census Bureau, over 20% of U.S. households speak a language other than English. What can we do to ensure that community banks can serve limited English proficiency individuals just as well as any other customer that walks in the door?
Well, one of the things that we can do is, one, as regulators, when we have disclosures and those sorts of things, we can make sure that they are provided in languages other than English. So that can actually assist and help facilitate the banking institutions to be able to use those forms. But another thing that we can do is we can continue to invest in our minority depository institutions that are in fact often the institutions that are located in those communities and providing services. And I think that in particular is one of the best approaches that we can have to addressing that concern.
Well, I want to talk about a recent report from CDFIs, which states that women and employees of color still fall behind white men in being represented in several key jobs, including only 27% of economists were people of color and only 34% of their examiners were women. I know we have at least one former examiner here in the room. It's kind of nice to hear that Mr. Hill gets nervous still. Do you think President Trump's recent actions to fire Director Chopra from the CFPB, imposing government-wide hiring freeze and nonsense attacks on diversity, equity, and inclusion initiatives will aggravate the challenges at CDFIs as well as other agencies?
I think it will. I mean, I think we are looking at the reality that 8 out of 10 net new households created in the United States are households of color. And given that that's the reality, it is imperative that we make progress in serving communities of color and customers of color. So increasing diversity, recognizing it as an advantage rather than a challenge or something to be looked down upon should be a critical priority.
Thank you. Now I want to focus on the outrageous overdraft fees that large banks charge to users. More than a third of working class people earning less than $65,000 a year pay overdraft fees each year. This isn't once or twice. Many of them pay hundreds of dollars in overdraft fees and risk losing their bank accounts if they cannot afford those costs. The CFPB recently issued a rule that would cap the overdraft fees to $5 to help protect the hard-earned money of working class consumers. My colleagues on the other side of the aisle recently issued a Congressional Review Act, CRA resolution, that would rescind the CFPB rule. So how would reversing the CFPB overdraft rule harm working class people?
Well, for all the reasons that we've talked about during this hearing, now is a time where people are experiencing significant financial challenges. One of the things that we have to talk about when we talk about overdraft is a series of regulations that have taken place. It's not just that consumers are paying $35 right now for an overdraft of $2, but it's also that it was true that financial institutions had the ability to kind of pick and choose how they would allow transactions to hit in order to amplify the amount of money that was being charged. And that is why it got the reputation of being a junk fee. So if we repeal this regulation, which by the way, does not apply to community financial institutions, which is one of the reasons why it's interesting that it's being considered in correlation with this hearing. But if we repeal this, then we're looking at the reality that consumers will continue to pay.
Gentleman's time's expired.
So it just applies to large institutions. Thank you.
Gentleman's time's expired. The gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to thank the witnesses for being here today. Many of us here could easily speak for hours about the CFPB under the Biden administration and how its policies have expanded government overreach. We all have stories from our districts, stories from constituents and small businesses negatively impacted by Mr. Chopra's actions over the last 4 years. We all believe in the mission of protecting consumers, but the extreme policies put in place by Director Chopra have done more to harm consumers than they have good. After the election, just weeks ago, Chairman Hill and Chairman Scott in the Senate sent letters to all government agencies in the jurisdiction of Senate Banking and House Financial Services, encouraging those agencies to halt rulemaking and new enforcement actions until new leadership could be confirmed. Almost unanimously, those requests were well received and the various government agencies proceeded accordingly. Not surprisingly, there was an exception, the CFPB. Director Chopra, we're going to get the records, but it seems that they just went on a flurry of enforcement actions. And one of them, at the very last minute, adversely impacted multiple businesses in my district. So I guess the news was received Saturday morning, just a few days ago. And Friday, this is kind of crazy, Friday at 5:55 p.m. and at 6:05 p.m., businesses in my district received CID. For those of you listening, that's basically a subpoena. It's a civil investigative demand. And these, if you're publicly traded, have disclosure requirements. You have to tell the world that you're under investigation by the CFPB, and that has an adverse impact. How many people think that the CFPB has people working every Friday at 5:55 p.m.? I would bet that's the first time ever. And, I even think Director Chopra might have sent these CIDs out himself right before he submitted his resignation. So let me tell you what I spent my weekend doing. I get a call Saturday morning. These businesses are very concerned. They obviously know that there's a new direction because of the election. And again, I just want to clarify, the election results are exactly the response to this type of approach to government. We have been out of balance the last 4 years, and we are going to find balance. So I worked all weekend to notify committee staff, to notify Chairman Hill and Chairman of Financial Institutions Barr, and worked on a letter. And so I ended up sending this letter to who I thought, this is the best part, I thought that she was the acting director at the time. Because I was unaware of the development that we heard about Monday. But I just asked who I thought was the acting director, Martinez, to basically not send these CIDs out. The email was sent notifying these businesses that they were going to send by certified mail Monday, which would trigger disclosure requirements on Wednesday. And so I sent this letter out. I emailed it to her. Mr. Chairman, I would like to submit these for the record.
Without objection.
Thank you. So obviously worked feverishly all weekend to try to get these businesses in my district relief. I guess, Ms. Rainey, do you believe that it is normal for the CFPB to send out CIDs Friday after business hours?
Seems a bit extraordinary to me, but I'm not familiar with after-hours practices.
Government workers use government hours. I can guarantee you that is not normal, and we're going to get to the bottom of this. I think that Chairman Hill and Chairman Scott have requested a list of all the enforcement actions that they have engaged in. So obviously, I was very pleased when I found out that I sent the letter to the wrong acting director Monday morning. We had dinner with Secretary Bessent Monday night, and I thanked him for giving these businesses relief. And this is crazy. Not only did they send out these CIDs late Friday night, but after the news broke on Monday, Bloomberg, I think, got it first, CFPB staff initially said that that action does not apply to the CIDs that they sent. Obviously, they changed course a few hours later after additional questions, but this is not the way that businesses need to expect the government to interact. We have to protect consumers 100%. I'm all in. But when the CFPB goes rogue and starts acting in this manner, it is detrimental to the U.S. economy,
Gentleman's
and
time
we got to
has
put a stop
expired.
to it. Thank you, Mr. Chairman.
The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well. And I am very much concerned about small banks. I understand that the definition of a community bank per the FDIC is a bank with less than $10 billion in assets. But small banks are important to me because literally I'm here because of a small bank. I went into a bank in Houston, Texas, small bank. And I needed a loan when I was in law school. Small bank. The president of the bank interviewed me for the loan. As a member of Congress, I can walk into a bank today and probably not meet the president. Small banks get to know people. They put a lot of stock in what people can do based upon sometimes an interview. Well, I hope you can understand why I'll pursue this line of questioning. Unfortunately, small black banks suffer. They can't get capitalized because, first of all, they service an area where you don't have a lot of billionaires, and they have regulations that require them to help certain people, and I support this, but they don't get capitalized as quickly. Most banks in this country have assets under $1 billion. There are thousands of banks, more than 4, probably. But when it comes to black banks, less than 25. Now, there's something wrong with this picture. That we have to have more black banks. Not to get a lot of heat because I support black people. I would just hope that someone would understand that having grown up black, having lived black, having suffered black, having benefited sometimes from being black, that I'm going to support black people and black banks. So please understand, what can we do to enhance the opportunity for us to have more black banks? Ms. Owen, you've been banking a long time. Where did your bank capitalize that? Assets?
Our assets are $490 million.
490 million. So you appreciate the smallness of banking.
Yes.
I have a bank in my district that is small, less than $1 billion. I have many banks, by the way, in my district, but you have a problem with technology. What can we do that can benefit you, which will probably benefit some of these black banks that are trying to hold on? What can we do?
Well, first, I would like to say that both the American Bankers Association and I strongly support funding for MDIs as well as CDFIs. They fulfill a hugely needed niche for banking, and believe in them strongly. Lessening regulations would be huge in helping us be able to expand our technology efforts.
May I just comment on that?
Yes.
When we've tried this in the past, I've been here for a number of years now, the big banks always swoop in and say, well, we'd like to have that too. Can the small banks stand up to the big banks such that we can do something for the small banks and not have to fight the big banks all the way and in the end not get it done because the big banks won't allow it? Can you stand up?
Well, I believe we do stand up and share and speak our mind when we come to DC with Congress and our senators, and we do advocate for ourselves. But I also have to say that I believe big banks fill an entirely different niche than what community banks fill. So there's a need for all of us, and we can work together.
Thank you. Thank you, Mr. Chairman. I will yield back the balance of my time.
Gentleman from Texas yields back. The gentleman from South Carolina, Mr. Norman's recognized for 5 minutes.
Thank each of you for being here. You know, by hearing the conversation and the questions that are being asked, it shows you the dichotomy that we have. Now, I like my good friend Al, but I don't know what a black bank is, nor do I know what a white bank is. I know what an American bank is.
Will the gentleman yield?
Y'all are in a...
I can tell you what a black bank is.
Hold on, let me finish. I'll get after with you. I don't know whether a black bank or white bank. I know an American bank. Y'all are in a competitive business. And Ms. Owens, I mentioned to you, what we're battling up here is just what my good friend Ms. Garcia said. Their answer is government regulations to everything you do. Junk fees, taking credit reports that omit bad debt. I'm sorry, you rank credit as it is, and all you have to go on is history. And so and that's why the American people chose $77 million chose not to continue the last disastrous 4 years of government regulations that each one of you have talked about. And this DEI, thank God President Trump has eliminated that. It's merit-based. And some of the most successful bankers I know have been of all races. When you get a bank loan, you don't look at, and I'm sure my good friend will realize that if he goes to get a bank loan for a property, if one with, I guess he describes as a black officer, has a 5% higher rate on the interest rates versus someone that is a different color, he's going to pick the lower rate because it's better for him. Anyway, my point is to you, Ms. Owens, y'all need to stay involved to fight this kind of thing because, as has been mentioned, the CFPB has been overregulated and an agency that should be abolished, and which hopefully we'll try to do. But you've got more power than you realize as far as your customer base, and you're in a competitive business with other banks. You get big because of good service, because of being competitive, not for making bad loans where you don't know what the credit score is and where you're forced to hire somebody because anything other than merit, which I'm glad this president is doing. Mr. Kennedy, I know in your testimony you mentioned that serving as a bank board member or control investor should be rethought. You also said that appropriate pricing of examination application fees may be adjusted. And I agree with both of those. Would you give me some, I guess, guardrails that you would recommend?
Well, it's difficult to do that. I do think just the initial point is that the industry should be self-funding. So we've got the regulatory structures, but they need to be efficient as well. They need to be educated. And if we need to provide the funding for the regulatory agencies to understand what's going on and better understand what's going on in technology, AI, and what the future will bring, that's the key point in my view there. Director liability is an issue that's been in the law for a long, long time, and it's gotten worse. And if you just step back and say, why don't we have as many community banks? That's one of the key reasons. So we've got to rethink that. I don't have any immediate, I can provide some more detail about it, but it's a topic that keeps people from going into that business.
I agree with you. And community banks, we all have been on bank boards, pretty much everybody up here. But it's regulations that keep bank boards back from showing profit on the bottom line. It's the reluctance of board members to get involved because most states need tort reform. South Carolina is one of them that indirectly affect your banks. What can we do more to incentivize and help what you're doing? And Ms. Rainey, I'll start with you and you go down the line.
These conversations are a great start, but I think, as we've talked here today, de novo, and as Mr. Kennedy alluded to, how we create new charters, how we ensure in regulation, whether it's our ability to work with fintechs and create a community bank fintech partnership and some clear rules of the road would be incredibly helpful. How we ensure that the examination environment is, again, proportionate to the risks that we represent. So for well-capitalized, well-managed institutions to extend the timeline between those examinations. As we've reviewed here today, I think there's many pieces where, again, let's think about it about not a one-size-fits-all solution.
Thank y'all so much.
Gentleman's time has expired. The ranking member for our Small Business Committee in the House, Ms. Vasquez of New York, recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Spatzer, I wasn't prepared to make the question that I'm going to be making now. I have another set of questions, but listening to the attacks to 1071 and falsehood, I felt compelled to set the record straight. So, the ranking member and I have been longtime champions of Section 1071. We wrote it. Can you explain how Section 1071 will increase lending to small businesses?
Well, Section 1071 is a sunshine provision. It lets the light in on what is actually happening in small business lending across the country. And the way in which it does that, it differs than just call report data. It requires the reporting of the race of the applicants. It also requires reporting around denials. And in doing that, it will help us make informed decisions about why people are not getting access to business loans in the United States.
And can you explain how the majority of community banks are exempted from Section 1071?
Yes, because actually when the Consumer Financial Protection Bureau issued the regulation, they were very careful as part of that process to exclude a number of financial institutions, making over so that the actual regulation establishes a threshold of loans that have to be accomplished before the reporting requirement kicks in.
And can you explain the other steps the CFPB took to make the reporting requirements less burdensome by giving them more time to comply?
Yeah, so one of the really interesting things here is that the provision, which has actually been on the books for 15 years, was not actually, after the regulation was finalized, implemented immediately. It has a phase-in period, and it actually allows smaller financial institutions an extended period of time of compliance. Currently, the regulation's effective date has been suspended altogether.
And isn't it true that most banks are already collecting most of this information?
I would think that a financial institution would want to collect financial information relating to its business clients. It may not be true that they're collecting information directly about their race and those dynamics, but it is certainly true that they are collecting information about their business profile.
Through HOMDA. Can you explain how the CFPB was required by law and then a court order to write this rule, and this was not something the CFPB chose to do?
Yeah, the small business lending provision was, as you acknowledge, a requirement of the Dodd-Frank Act. It has been on the books for the past 15 years, and unfortunately, there was a lag in implementing it. During that time period, we have still had a lack of access to capital for minority small businesses in the United States.
Thank you for setting the record straight. To everyone on this panel, I support community banks. I have already publicly said I want to work on FDIC insurance and deposit insurance reform in order to make them more competitive. Yet, President Trump and his Republican allies want to eliminate the FDIC altogether. Does anyone think eliminating the FDIC is a good idea? Does anyone think this will make them more competitive? Yes or no? Do you think it will make them more competitive?
We don't know enough to know that. We need deposit insurance in this country. The FDIC plays a very vital role.
That's a good start. Ma'am?
The federal banking agencies, the FDIC, the Federal Reserve, and the OCC are our partners in supervision for the institutions. And just like the foundation of the dual banking system, where banks have a charter of choice, whether they choose the state charter or the national charter, they should be able to choose whether they want a federal charter, federal supervision of the Fed or the FDIC. And the protection of the FDIC insurance fund is very important to the stabilization of our
My
community
question was
banking
a
industry.
yes or no, if you agree. Yes.
Yes, the FDIC plays a critically important role, and in its absence, it would be highly problematic for all financial institutions.
Thank you. I yield back.
Gentleman yields back. Mr. Muser from
We're afraid to
Pennsylvania is
answer
recognized
that
for
question.
5 minutes.
Thank you very much, Mr. Chairman. Thank you all to our witnesses very much. So over the past 4 years, community banks have been a little bit under the gun, from 1071 to CRAs to overdraft fees being eliminated. Credit card late fees and such have been reduced, I think, from $35 to $8, something of that nature. My guess is if we reduced speeding tickets from $100 to $5, there'd be a lot more people speeding. So my guess is you've got a lot more community banks overdrafts taking place. And I'm hearing a lot from my community banks as well about the increased cost of compliance and regulatory burdens. In fact, I just heard a story not too long ago where CFPB came into a bank, a community bank, and said, hey, how we doing? And they said, well, not well. I've had to hire 3 new compliance officers to help. And the CFPB and manager representative stated, well, that's wonderful. We're creating 3 jobs. So they really don't get it. The Pennsylvania Bankers Association obviously pays a lot of attention to community banks as they're central throughout Pennsylvania. And they informed me that recently a de novo bank was told by the FDIC to slow its deposit growth because it was meeting a new yet underserved population that happened to be Amish. Again, brought to my attention by the Pennsylvania Bankers Association. So, Ms. Marshall, is this something that you found FDIC meddling in?
I do not have an example specifically of what you're describing, but I will tell you that the concentration of power at the federal banking agencies here in D.C. needs to be reversed, and that delegation of authority needs to go back down to the regional offices of the FDIC or the districts of the Federal Reserve, because they, like state regulators, are local. They know the communities, they know the institutions, they have a better gauge, and so we don't need a one-size-fits-all approach to the federal oversight of our industry. We need that appropriate balance between centralization of direction, but we need that execution and that independence of those individual districts and regions to make the best regulatory structure for our institutions.
And have you found that to be the case? I mean, has the FDIC been engaged in such drive-bys and stop-bys? I mean, are they basing it upon the reserves? Are they basing it upon a business equation? Or are they just basing it upon a de novo bank that happens to be growing faster than they predicted?
Again, I have not heard anything specifically, but I hope that all regulators, like I do, focus on safety and soundness, consumer protection, and in a de novo situation, you're looking closely at the business model and the business plan, but work with that institution. You don't want to stifle the growth or the opportunity for those banks to serve those communities, especially when we have a new de novo in place. That can be balanced with true risk management practices and to ensure that the bank and the regulators are working together for the best outcome. And I believe banks do an excellent job overall of managing risk. That's what they do every day. And so that collaboration and discussion between the bank and their regulators is very important.
Okay. I'd like to ask you about the importance of raising the FDIC insurance from $250,000, particularly perhaps for small business payables. But I'd like that answered. But Mr. Kennedy, maybe I can just start with you and we just go down the line. Community banks are not happy. There's not one that I meet with that says, hey, we don't feel under duress. We feel great. We're flexing our muscles. We're gaining new customers. We're rolling. They're feeling as if they are being somewhat suffocated. What can we do in this committee and in this Congress to improve that situation?
Well, thanks for the question. It's the question of the day. And frankly, what the chairman has put out is, a masterful list, and others who've talked about the legislation they've planned or have already engaged in provided. But I think that based on my 45 years of watching this industry and participating in it, something really dramatic to remove community banks from the heavy regulation that Congress has put on them. You can't blame all of the agencies because really the law is here. And that's what started. And all of it has been in reaction, but it's been an overreaction. And it starts out, well, it's only the big banks, but then it's trickled down. And you can ask any community banker that the trickle-down effect is always there.
Thank you. Mr. Chairman, I yield back.
Gentleman's time has expired. The gentleman from California, Mr. Liccardo, is recognized for 5 minutes.
Thank you, Chairman Hill, and thank you, Ranking Member Waters, for holding this hearing, and thank you to all witnesses for coming forward to speak. I very much appreciate the testimony. I've learned quite a bit. I guess I had a question primarily for Ms. Romero, Rainey, about as you look across community banking in this country, is it fair to say that that CRE, commercial real estate lending, is a significant share of the portfolio for many banks?
Yes, it is.
And what steps do you believe are necessary from the standpoint of the banks to protect against volatility in that market that we're seeing today?
Yeah, this is something that community banks are experienced in doing and have over time in terms of knowing that the markets change and we have to prepare for that volatility. The other thing that I would really point out, when you look at a traditional community bank's portfolio, majority of their CRE is owner occupied. And so that creates a very different dynamic as we think about the cash flows and the impact in terms of how that business is able to manage. They're typically in those investments for the long term.
But some significant share, and I think I saw an FDIC report suggested it could be more than 30%, is non-owner occupied, non-residential. So this could be office, retail, hotels, et cetera. And I guess what I'm concerned about as a recovering mayor of a city is I've had those conversations as long ago as 2 years ago, listening to developers, owners of these properties, telling me a lot of keys are going back to the banks. And when they do, the valuations are going to be severely reduced. And the banks are going to be inheriting a lot of very poorly performing assets that are very far underwater. And so I'm wondering at this point, knowing what we think we know about the state of commercial real estate right now, is this the time when we need less regulation over, for example, issues around portfolio safety?
So a couple thoughts there. First is, as I look at concentrations of commercial real estate, a lot of this is going to vary regionally. I am candidly not hearing a lot from our members that their CRE portfolios are struggling. So there will be pockets, and that will have to be dealt with. But again, that's a perfect example why one size fits all is not the approach that we need to take here. And again, as I started with my comments, that's the beauty of a community bank, is that these are portfolios that they've built expertise and years of mastery in terms of knowing how to weather those storms. And so, again, let's look into those areas of challenge and think about how we support those communities as opposed to painting with a wide brush in terms of how we support the industry as a whole.
Well, forgive me for staying at the wide brush for a moment. Nationally, I think in the fourth quarter last year, the vacancy rate was 19.8% in office. And a lot of folks believe that's a significant understatement, given what we know about the fact that an awful lot of space is being subleased, and those leases are coming up. And essentially, there's going to be a lot of non-renewals. And I'm thinking about that. I'm thinking about, I know in the hotel industry, we're seeing significant number of foreclosures on the West Coast. And I can't help but wonder if at some point the other shoe is going to drop, and to what extent these banks are going to be as aware, small community banks, about the severe difficulties that are really underneath the surface. That vacancy rate, by the way, is about twice as high as it was right after the Great Recession, 2009. This is a monumental moment for a failure of commercial real estate. How can we be assured, sitting here, that 2 years from now, we're not going to be having hearings about the string of bank failures that are resulting from all these failed investments, or all these failed loans, I should say?
Well, what I know today is when you think about a community bank operator, they're the ones right there on the ground watching what's happening in those markets and in those buildings, so that we suggest a surprise in terms of a sudden shift that they're not prepared for. That's not the community bank business model. They have proactively, they are monitoring again, they are there in those markets watching that happen. And so how we prepare, give the flexibility, and take into account the fact that they are there within those markets.
Gentleman's time
means so
has
much in
expired.
terms of the decisions that are being made.
Thank you. I yield.
The gentlewoman from California, the chairwoman of the Asia Pacific Subcommittee on House Foreign Relations, Ms. Kim, is recognized for 5 minutes.
Thank you, Chairman. I want to congratulate you on holding this very first full committee hearing on a great topic, and I look forward to working with you as chairman of the committee. And I also want to thank all of our witnesses for joining us to examine how we can make community banking great. Today, I'm concerned about the decline of our community banking in our country. You know, since the 1980s, the number of banks in America has declined from 18,000 banks to less than 5,000 banks operating today. You know, what that means is that less banks in our communities means less competition, less access to capital for small businesses, and less essential banking services for communities that need it. So let me ask the first question to Ms. Romero. You know, can you give us your view on how we got to this point of having 13,000 less banks today than what we had in the 1980s?
I think it's accumulation of looking at this industry from a one-size-fits-all approach. When you look at the compliance costs and the regulatory burden that have just been added on and added on in the last 2 years, over 4,000 pages of new regulation, that comes at a cost.
Can you tell me, how much does it cost for a community bank to comply with state and federal regulations?
It's significant. I mean, those are the stories that we've heard today of, you know, banks adding more and more compliance officers. Those aren't folks on the ground helping small businesses get to the next level, figuring out how to finance and transition that business to the next generation. And that's the shift that I think we really need to focus on.
I share with you, and my sense is also that the small banks are more worried about complying with regulations and focusing on, you know, what they need, you know, how to comply with those regulations than focusing on what they need to do best, and that is making those capital available for businesses and for worthy projects that they want to fund. Mr. Romero, I do have concerns about the supervisory appeals process as well, that it's not being very transparent and having very little oversight. So can you give us your perspectives on how we could improve the supervisory appeals process and make it more transparent?
I appreciate the question, because that's all we're looking for is transparency, and very much appreciate Chairman Hill's bill that would create this appeal process and examination transparency by looking to the FFIEC to have a independent approach in which bankers can raise their questions and challenge the findings.
Sure. And Ms. Marshall, in your testimony, you speak about the need to facilitate community bank innovation through third-party partnerships. Can you speak on how greater regulatory certainty and clarity with third-party partnerships can help small community banks, and how can it help consumers have greater access to many banking services?
Yes, ma'am, thank you. And I think the consumer is a large part of this conversation because they are demanding that they utilize new products and tools and services to meet their banking needs. They want that, they expect that. And so community banks are needing to keep up because, quite frankly, they may not be able to innovate themselves, but that partnership gives them that opportunity to continue to serve their customers and attract future customers. But the ability to do so is going to be very the successful ability to do so is going to be very important as we look at improving and enhancing current third-party risk management guidance. We need a regulatory framework that is clear-cut, a roadmap that gives the rules of the road for banks to be able to follow, and not just them, but the third parties themselves, as well as the consumer. You need clear guidance, we need clear definitions, and we need it to be a transparent process in how regulators and bankers and quite frankly the third parties can facilitate those conversations about what that looks like for the next generation, because it is here to stay. Sure. And I think it's very important for the vitality of our industry and meeting consumer needs.
Thank you. Ms. Owens, let me ask you a question. And you know, in my home district in Southern California, I regularly meet and hear from small business, the banks, of the need to enact the safe banking legislation. So can you talk about that, how enacting safe banking legislation can help local community banks?
Banks do need good legislation, but it needs to be clear, it needs to be tailored, it needs to be very thoughtful in its implementation and timelines.
Gentlewoman's time has expired.
Thank you, Chairman. I yield back.
Gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you so much, Mr. Chair. Can everyone on the panel agree that our government should be promoting residents' economic security, not serving the whims of billionaires? Does everyone here agree to that? If you disagree, raise your hand.
I didn't understand your question, sorry.
Is our government's role and responsibility is promoting our residents' economic security, not serving billionaires? Okay, you're uncomfortable, Mr. Kennedy? Oh, okay. I just want to clear, we're community banks, right?
Just thinking about
We
my
support
answer.
real people. No, we're community banks. I don't know, maybe you do have a lot of billionaires you serve. I don't know. But this is important because the topic of today's hearing is community banking, but we just can't act like there isn't a crisis going on. Do you know the people calling my office? It's hundreds of people calling my office right now saying what's going on. With access to the Treasury payment system, Elon Musk can simply stop funding any federal government programs like Medicare and Social Security. My residents know that he doesn't care about them. They're not experiments. Our people and our communities and our families are not experiments for Elon Musk. And so it's really hard to be in this space to talk about something that I think a lot of people do care about. But at this moment, we're acting like there isn't a crisis going on in our government right now. One thing I do want to talk to you all about, and I think it's really important, is, and this is for any of the witnesses here, do you know which state right now specifically, and to get to community banking, but which state has the most community lenders per capita? Does anybody here know? No? It's North Dakota, which has around 64 banks and credit unions per 100,000 residents. It's pretty great, right? North Dakota has 6 times as many locally owned financial institutions as the national average. Does anybody on the panel know that? No? Yeah. For any of the witnesses, again, what makes North Dakota so special in its support of community lenders? Can anybody guess? Do you know what makes them special? A large part of the answer is the Bank of North Dakota. The Bank of North Dakota has operated successfully as a public bank for over 100 years. Today, it provides business loans, student loans, home loans, and agricultural loans. I don't know if the chairman and others know this. Public banking is incredibly important to support in our country, especially during this time where we see a lot of folks in the stronghold of, again, the economic security and the future of our families. Did you know that Bank of North Dakota invested $1 billion in legislative directed programs that build schools, water infrastructure, and medical facilities? A public bank did that. In 2023, it returned $140 million to state general fund, and over time it has returned more than $1 billion in funds to the state, money back to the state, to the communities. And I don't even know if my own ranking member, Congresswoman Waters, knows this, but importantly, the Bank of North Dakota doesn't compete with community banks. They don't compete with you all. It partners with you. About half of its $5 billion loan portfolio is lent in partnership with community financial institutions. Participation loans increase the capital available for community development, provide community lenders with greater access to capital. And this is important as somebody that authors the public banking bill. Thanks to the Bank of North Dakota, no banks in the state failed during the 2008 financial crisis. I'm going to repeat this. No bank in North Dakota failed during the 2008 financial crisis. In fact, the bank continued lending while others pulled back, helping the state achieve the lowest foreclosure. As somebody that literally lives in the county, one of the worst foreclosures in the country in Wayne County, Michigan. But it helped achieve the lowest foreclosure and credit card default rates, again, the lowest. My Public Banking Act would actually help states establish similar, robust community banking sectors, which would be partners to all of you. And if we're serious about assisting community banks, we should look to long-standing and proven track record of Bank of North Dakota. This is so important for many of my colleagues, many are not here right now, hope they're dealing with the crisis that's happening. However, it is important to understand the role of public banking. It is not something of the boogie thing. It's actually a great way to, again, protect the economic security and future of our families that, again, feel like we don't have their back. With that, Mr. Chair, I yield.
Gentlewoman yields back. The gentleman from Florida, Mr. Donalds, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm not even going to get into it. Thank you so much. Mr. Kennedy, how has the regulatory structure imposed by Dodd-Frank negatively impacted community banking in the United States?
I think it was about 1,000 pages of legislation by Congress and probably 10 times that of regulations that were issued under that act.
Okay. And specifically, in your view, has community banking in the country, frankly, been devastated by Dodd-Frank?
Yes, when you step, I mean, it was done to react to a problem or series of problems, clearly, but it was an overreaction, and it applied to every bank in the country and beyond. And so it's stepping back. It's a serious problem. It's overregulation.
Okay, thank you. Ms. Rainey, can you discuss how increasing the asset threshold for small bank holding companies could help with capital formation?
Yes, I appreciate the question. So as we increase that threshold, what we allow these smaller bank holding companies to do is to grow, to lend more, and potentially partner with other smaller community institutions to keep that presence in the local community.
Okay, awesome. And do you believe that a proliferation of small banks and small bank holding companies would be better in terms of addressing the needs of capital for individuals, micro businesses, and small businesses?
It is the answer, and that historically, when we look at the footprint of small businesses in this country, which is unlike anywhere else in the world, we can attribute it directly to the presence of small banks and those that are on the ground that are taking that local capital and redeploying it to small businesses so that they can grow and create additional capital for that community.
All right, thank you. Ms. Owens, can you describe the role community banks can play in revitalizing local economies and uplifting American communities?
Absolutely. I'm a proponent of the ACRE, access to credit for rural communities, which will provide lower interest rate loans as well as additional credit to our rural communities and our farmers and our ranchers, to the agriculture that is so vital to not only my state, but our country.
Okay, thank you. Ms. Marshall, what immediate action can Congress take to address the regulatory cliffs you mentioned in your testimony?
I think starting with the static thresholds that have existed, we need to review those. There need to be indexed for the current environment, the current economy, so that banks can continue to grow and expand alongside that economy and not fear that they, as they approach us, arbitrary asset threshold, that they either need to pull back from their operations or, quite frankly, seek another alternative. We need to let them continue to grow alongside in the natural pace that they will be able to keep up from a risk management standpoint. And we need to take that stigma away that there is something magical or something horrible that happens when you cross over to be a $10 billion bank. As I said earlier, $10 billion is not the threshold that should define a community bank.
Let me ask you, Ms. Marshall, to follow up, what do you think the threshold is that should be defined in community banks in the United States?
Something north, I've never been asked that, Mr. Donalds, thank you very much. Certainly something north of 10, maybe something less than 100.
Fair enough. No, and I understand why you don't, as a former community banker, I understand that a $10 billion bank, although it is big, quote unquote, you're not talking about the national banks, which are massively larger than $10 billion. I do acknowledge that. One before I yield, Mr. Chairman, it was raised about the Bank of North Dakota. And as a former banker, or I would say a recovering banker, the state of North Dakota, the reason why they had to create a state bank is because there was no ability for any lending to occur because there was no banks in the state of North Dakota. I'm quite sure every American understands, especially people from North Dakota, that it is a very rural state. It can be a very tough state, and there was not a lot of banks that could survive in that climate. So the state of North Dakota decided, I believe in around 1910, 1920, decided to create a state bank in North Dakota. It still remains to this day. I know that there are people in other states who've brought up the idea of creating a state bank, but the reality is that commercial banking has been able to supply the needs in everybody's cities and economies, and there are now obviously community banks and other banks that operate in the state of North Dakota. So I don't think that the topic of raising a state bank is the panacea to whatever the ills might be coming from the other side of the aisle. The real cure is unwinding the regulatory behemoth that is Dodd-Frank. I yield, Mr. Chairman.
Gentleman yields back. Gentleman from New York, Mr. Torres, is recognized for 5 minutes.
Thank you. There are 45 million Americans who have no credit score, who have been deemed credit invisible or unscorable, according to an analysis by VantageScore expanding the scope of credit scoring to include alternative data like rent payments would generate a first-time credit score for about 33 million Americans. And of the 33 million, 13 million would have a credit score high enough to qualify for a mortgage. Ms. Spotzer, do you believe, as I do, that banks should originate mortgages based on credit scores that take into account alternative data like rent payments?
Yes, I think it's a very important concept, and I think we're very pleased and supportive of the Federal Housing Finance Agency's efforts to make sure that the GSEs pursue it.
Okay. Ms. Rainey, do you have any thoughts?
I think this is something that community banks do today, and it's something that I love about relationship lending is it's not just credit score driven. We're able to take into account many of those factors, and so I'm appreciative of anything that brings that information to the table.
There are 5.6 million households, 4.2% of the population that are unbanked, 19 million households, 14.2% of the population are underbanked. There's a national initiative known as Bank On that offers free or affordable bank accounts. In your experience, how effective has the initiative been at reducing the unbanked and underbanked population in the United States?
I don't have the information specific to Bank On, but I think so much of this is about education and creating pathways for folks to understand, to create connections to banks, and anything we can do to help with that is good.
Ms. Spotzer, do you have?
Well, I think education is important, but I don't think that's the reason why we don't have people are not getting access to bank accounts. I think it is the absence of service in communities that are traditionally underserved. One of the things that we've talked about is the absence or the consolidation of banks, but what we haven't talked about is the disappearance of bank branches by existing financial institutions in communities of color. And that has consequences that lead to an increase in lack of access and banking account opportunities for people of color.
In places like the Bronx?
In those places.
Mr. Torres, I'd like to
sure.
add, we do offer bank-on accounts and are very proud to do so, and it has certainly allowed us to bank some of our unbanked population and help them so that they can get direct deposits at the bank and protect those, protect them from the risk of their checks going through the mail and payroll checks and other things. So we're very proud to be able to offer that.
In spring of 2023, the fear of contagion risk led the federal government to insure the uninsured depositors of SVB, Signature, and First Republic. If the federal government feels compelled by contagion risk to insure the uninsured at the back end, why not provide unlimited deposit insurance at the front end? In finance, as in healthcare, it would seem to me preventative medicine may be more cost-effective than emergency medicine. What do you make of that argument?
Well, I think there's a lot we need to talk about here, and I think that there's two pieces of this. One is the contagion effect. The agencies should have had the ability to implement a transaction account guarantee immediately so that we weren't talking about a contagion effect. And then as we think about ultimately reforms to the deposit insurance system, how are we ensuring that monies are safe regardless of the size of the institutions, and that
But indulge my hypothetical for a moment. In a world of unlimited deposit insurance, what incentive is left for a depositor to withdraw all their deposits from a bank?
Well, there is none, but there's also a cost that comes with that unlimited insurance. And so how that then creates a disproportionate burden on the smaller banks is the piece that we need to solve for.
And so how can we How would you solve for that?
I would solve for it by thinking about a system of assessments that puts more of that burden on the largest
A tiered
institutions.
system of
Yes,
assessments.
yes.
What do you make of the role of the federal home loan banks as emergency liquidity providers? It's been said that emergency liquidity from the federal home loan banks is much more accessible than the Fed discount window. What do you make of that role?
I think the federal home loan banks play a very critical role in terms of providing not just immediate liquidity, but liquidity over time that allow community banks to manage their balance sheets and have, like I said, given seasonal aspects, whatever it may be, they're very critical to banks' liquidity.
I see my time has expired. Thank you.
Gentleman yields back. Now recognize the gentleman from Nebraska, Mr. Flood, for 5 minutes.
Thank you, Mr. Chairman of Wisconsin. The state of our banking system is not what it used to be post-Dodd-Frank. I represent a district and I live in a state full of outstanding community banks. In the 1980s, there were more than 18,000 banks in the U.S. Today, there are fewer than 5,000 commercial banks. When I started on the Nebraska Unicameral Legislature's Banking Committee, we had over 300 banks, and today we have 137 and dropping. One is consolidation, and the other is a lack of de novo charters when it comes down to the big issues, and I believe both have the same root cause, regulatory burdens. Ms. Romero, Rainey, in your testimony earlier today, you spoke to how inefficient and prescriptive regulations led to further bank consolidation. Can you expound on that point for our benefit?
Absolutely. I think, the core theme for me here is as we look at the community bank business model that is tied directly to relationship lending, we need to look at it through a lens of how do we proportionally manage that risk. And unfortunately, regulation that has been written over the years, 4,000 new pages in the last 2 years, has not been proportionate to the community bank business model. And that comes at a higher cost to community banks, which absolutely contributes to consolidation.
One of the things I love about our banking system in America is that it's diverse. You've got the GSIBs, you've got the regionals, you've got the community banks. And then you look at Europe, and how many banks are calling the shots over in Europe? A couple, a handful? And here we have this diverse system that's the envy of the nation, and we seem to be killing off one of the three legs of the stool. Let's talk about these de novo bank charters. We've seen a staggering drop in the number of these over the years. Congressman Barr's legislation would seek to address that problem, and I am a proud co-sponsor of the bill. Another question to you, Ms. Romero, Rainey. You made a really interesting comment in your testimony that your family's community bank, Sentinel, would not have been chartered today given the regulatory environment. Which specific barriers do you feel would have been most challenging to chartering a new bank de novo with the circumstances you had when your family bank started?
First and foremost, the minimum amount of capital. As we think about what is required, again, it's a one-size-fits-all approach, and so that has to be solved for immediately, especially as we look at access to capital in rural areas.
Very good. Mr. Kennedy, in your testimony, you touched on the importance of allowing community banks to innovate and use technology to confront some of the barriers posed by the regulatory burdens. I totally agree. And I would be fearful if I were running a community bank of getting into bed with a third-party vendor that could take me a place where my license could be suspended. But how can technology help smaller institutions face the challenges posed by the regulatory burdens? What do you think of that?
Well, I think technology can level the playing field and has for the last 20 years and will continue to do that. And there's a lot of different meanings to the word fintech, as I think the commissioner talked about earlier. We've got to be innovative, and the regulatory agencies have to understand that and give the banking community space to do that.
Do you think the regulators of community banks are as maybe open-minded to some of the fintech possibilities as maybe the large GSIBs with their regulators?
I think they are. I'm not sure that the leadership in Washington of late, particularly the last 4 years, has allowed them to be.
Very fair.
But I urge in my remarks also, in my written testimony, that we give the regulatory folks an opportunity, fund them better, give them the opportunity to understand and work side by side with banks as we innovate.
Ms. Marshall, appreciate seeing you again this week. A lot of banks in my home state have gone from an OCC charter to a state charter. Are you seeing that in Arkansas as well?
Absolutely. Yes, sir. There's only 7 state chartered banks and 7 national banks chartered in Arkansas. And so almost 90% of our banks are state chartered. That's happened fairly recently over the last few years.
Why is that?
I will say it's our relationship to those institutions, our knowledge of the local communities, our accessibility, our willingness to partner with them in a way that it's not inappropriate, but best suited for both organizations to maintain that healthy, vibrant community banking sector.
Do you think the OCC wants a larger bank to regulate? Do they want to be in the space of community banks?
I wouldn't be able to speak to what the OCC would or would not want. I can just assure you that our banks are pleased with the relationship they have with the state.
Thank you very much. I yield back.
Gentleman yields back. The ranking member is now recognized. For unanimous consent request.
Mr. Chair, I have a statement. I have a unanimous consent request to enter a few statements in the record. I have a statement from the Americans for Financial Reform, representing more than 200 groups supporting CFPB and its rules. I have 2 other letters from more than 200 consumer, civil rights, labor, and other groups supporting CFPB's overdraft rule. I have 7 other letters from various groups, including the Leadership Conference on Civil and Human Rights, Rise Economy, and the Responsible Business Lending Coalition, strongly supporting CFPB's Small Business Lending Transparency Rule, the National Bankers Association, and Inclusive, each submitted statements urging us to build on our bipartisan work to support CDFIs and MDIs. Last, the Free Speech Coalition submitted a statement highlighting how debanking hurts marginalized communities.
Without objection, we now go to the gentleman from Indiana, Mr. Stutzman, now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you for being here. This is such an important issue for our communities, and I come from a district in Northeast Indiana that is very diverse, a lot of rural areas, a lot of agriculture, a lot of manufacturing. We have, of course, the city of Fort Wayne, so we have an urban area, of course, and some suburban areas. And I've been absent from Congress for the last 8 years, and so I've been very active in our community in the business space, and have worked with a lot of our banks, small, medium, large, all of them, and working to create jobs and to make create better opportunities for our communities. And one of the things that I find interesting, and Mr. Flood, touched on it just a little bit of it, is the diversity in our banking system, which I find to be very beneficial as a business owner, and working with banks from whether it's startups or whether it's existing companies, agriculture, which is tricky. Not just any bank is involved in agriculture. And what I continually heard from friends in the industry is and I don't think that they even wanted to complain because they wanted to be sensitive and careful to the circumstances that we were in, but it just seemed like their hands were tied continually, in a variety of ways. And I know, one of the key themes for this hearing is just fairness, transparency, right-sizing the government. But President Trump signed an executive order which launched massive deregulation initiatives, including a provision to eliminate 10 regulations for each new regulation issued. I guess I'd be just kind of curious, would that be possible? Is that how easy would that be for the industry? And I guess, maybe especially for smaller community banks, don't have the large group of attorneys that are readily available to help. But I know that there's been a lot of hardships on the banks, which creates the hardships for small business and folks in the community that are really building up our small communities. And I'll tell you, rural communities are struggling. It's tough out there. And so that's why I believe this hearing is so important, and how can we help? And is that the right direction? I support President Trump's end goal and initiatives, but is that something that will be a useful tool?
Well, I think it is. And as we think about our theme here today, again, how are we thinking proportionally to the risks that we're trying to mitigate and manage? Because that really is what is at the core of a successful community bank is risk management. And so how do we provide, to your words, the flexibility for these banks to do the good work that they are, not just in the easy times, but more, importantly, in the challenging times? I mean, there's a reason that community banks make over 70% of the agriculture loans in this country, is because they're experts and they've proven their ability to stand the test of time. So to think about, to pull back, to repeal 1071, that would make that less effective or efficient, to think about the examination process in a different way for these smaller institutions, to think about their access to capital and ability to grow through the Small Bank Holding Company Act. I think there's a lot of ways that we can just think differently in a way that acknowledges the very different business model that is community banking.
Yeah, I only got a minute left, but I'd be curious, how's the next generation responding? Is there an interest in banking? Is there an interest in being a loan officer? I know we've got, one particular bank that has a really nice program with the local high school, with high school students, but is there an interest? Are you seeing that across the country? Because it's important for our rural communities to be viable going forward for generations to come.
I take a personal interest in that as a third-generation community banker, making sure this goes on to the next generation. And I think exactly what you're talking about, community banks grow their own, and they do it through internships, they do it through engaging with local schools, and this is where, again, we need more of that and really creating that understanding that a career in community banking is about giving back and engaging community. It's such a wonderful story.
Yeah, my fear is too much regulation drives people apart in the relationship business. And we're constantly critiquing, the bank's critiquing customers. It's important, but at the same time, there has to be a win-win for everybody involved. So thank you for being here, and thank you for your testimony today.
Gentleman yields back. I'm now going to recognize myself for 5 minutes. Thanks to the witnesses for being patient. I know it's been a long morning, afternoon. I just wanted to dig a little bit deeper into the CFPB, and the questions for Ms. Owen. And I know other members have kind of, talked a little bit about this morning. So Section 1071 rule requires lenders that make a certain number of small business loans to collect and report to the CFPB a total of, there's 81 separate fields, data fields. And it all applies obviously to the loan. So it's a gathering of information, right? Seems excessive, which is why I'm bringing it up. But as I understand it, a lender is required to comply with this rule if they make at least 100 small business loans. Arbitrary number. Ms. Owen, can you please kind of explain, or can you tell us any more information on the enormous data collection that's happening and what impact that has on small businesses, community banks, and the credit unions that serve them?
Absolutely. Thank you very much for your question. No doubt, trying to collect those 81 data points from a customer is going to be very difficult. Often they come in with basic information. We use financial education to help educate our small businesses and end up giving them a list of items that we need for them to bring back. So now we're going to have to add an additional amount of data that they will need to collect. And often these customers are very private, that they really don't want to disclose some of the information. We've had them often tell us, it's none of your business. And when we tell them we have to ask these questions, they often don't like it.
Yeah, let me interrupt you there, because it's kind of the next follow-up question that I had. Because 1071 requires CFPB to publish the data it gets from lenders every year, that's kind of what you're referring to as kind of this otherwise undisclosed information that small business people are uncomfortable with. If you include that information, whether the lender denied a small business loan or whether or not they're granted it, right? What steps do you think the CFPB could be doing to protect that information and the privacy that otherwise small businesses are not really offered any guarantee that that's going to happen? Is that correct?
Yes, we're very concerned about the release of private information into the marketplace and what it can mean for those individuals. As I've said before, it's not going to be difficult to determine whether or not someone was approved or denied a loan, especially in a small community where there are only so many businesses, especially of a particular industry. So there are great concerns there.
Thank you very much. To Ms. Rainey, kind of switching topics a little bit. Currently, credit unions, whether they're farm credits, fintechs, they're not considered competitors for the purpose of the concentration analysis done under the bank mergers, of which Congressman Barr and I have been working on a number of pieces of legislation on that front to make that more streamlined and easier. Can you discuss how this makes the bank mergers, especially in rural markets, kind of creates this artificially concentrated area? And it's misleading, I think. Would you agree?
It's absolutely misleading because it's not painting a picture of the full market. And so when you look at the other financial services providers, and if you exclude credit unions and farm credit, especially in rural communities, that does not tell the picture. And it, I think, hampers some of the opportunity for some of the smaller banks to merge and work together.
Thank you. The last thing I just wanted to touch on, I guess, is, again, going back to Ms. Owen. So community bank lending to farmers and ranchers is critical. And we hear, especially from, obviously, a number of members that either have been or have some type of history on that issue, whether they're on the Financial Services Committee or they may be on other locally served community boards that are focused on farms and ranchers. Can you tell us again that access to credit for Rural Economy Act, it's a bill that we've been working on, how this could be implemented and how this could be very important, I think, to those communities that are kind of watching what Congress is doing right now?
Yes, it will lower the cost of financing for our farmers and ranchers, the agriculture industry, rural communities, as well as allow additional access to credit for them, which is vitally important. They are in need of this.
Thank you very much. I'll yield back. I'll now recognize the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, and thank you for our witnesses for taking time out of your businesses to come share with us and hopefully make the market a better, more functional place. You know, Ohio is home to many strong community banks and some bigger regional banks, and we have a diverse financial services sector in our own state, and it reflects the potential strength of our country's economy. But, you know, maybe one of the themes that we will do is making America great by making our community banks great again, but maybe by re-privatizing our economy, because for a while it's felt like the federal regulators have decided that they need to weigh in on almost everything. And so, you know, I really just, you know, Ms. Marshall, I wanted to ask you about, you have state-regulated banks that choose to do that for a reason, but of course, there always seems to be a federal nexus. So could you kind of highlight for us what that tension's been like historically and maybe lately between state regulators and federal regulators?
Thank you for the question. Yes, as a state bank, you're going to have two regulators, the state regulator and the federal regulator of their choice. We work very hard at the local level to make that as seamless and efficient and effective as possible, but it's that direction that's coming from DC that is directing perhaps challenging their local offices to manage situations in a specific way and overriding what the examiners on the ground may feel or think is the appropriate outcome. One of the things I think that could really make a difference here is, quite frankly, Congress's support of the existing law, which is to ensure that there is a state bank regulator that sits on the FDIC board. That is in law, and someone with state bank regulatory experience, pardon me. And that is something that has been absent for quite some time, and I think that would help temper this overarching direction that we've seen for quite some time. And I think that would help ensure that there was an equal voice for state and community banks to provide this common sense approach and balance out some of that direction.
Yeah, I think we're hopeful that we'll get somebody with that kind of regulatory experience, even at the Fed, when we look at the Fed's desire to reach into virtually everything as well. You know, Ms. Owen, when you look at your experience in the market, you know, one of the things that you see maybe across sectors is that consolidation and concentration generally reduces innovation, and it almost always reduces competition. How have you seen that play out in the market as a community banker?
Yes, we have certainly seen a consolidation within the state of Arkansas and frankly across the country, as you've seen with the shrinkage of the number of banks. It hurts all of our communities when they lose a financial institution. That a successful financial institution is so vital to each and every community. So we are very much in favor of de novo banking and making the requirements on capital not so onerous, as well as allowing more time for compliance with regulation for these de novo banks.
Yeah, I appreciate you guys have highlighted some great legislation. Some of my colleagues have, you know, with Congressman Donalds on the Small Bank Holding Company Act, Congressman Williams on the 1071 fix, Congressman Barr and others on some of the community bank regulations that deal with capital leverage ratios. And I was speaking with a small community banker today. They're holding 17%. And so the whole concept of tailoring is out the window because they're being pressured. They don't really own their own balance sheet. They can't decide what's on their books in their own way. And that's a factor. Ms. Rainey, could you talk about that? Have you had some observations in the market where it feels like regulators are steering lending decisions instead of the banks?
Yeah, and I think that's core to all of this is community banks have proven their ability to manage risk, to understand their local markets, and let's give them the freedom, flexibility to do that.
Yeah, thank you for that. And maybe the last question for you, Mr. Kennedy. You know, structure makes a lot of difference, and one of the, I think, really important innovations is, you know, the way that you get a return isn't just leverage, it's also, you know, how you can retain some of the equity, and a lot of the equity in a lot of business deals goes to the IRS. You have the S-Corp election for a lot of smaller banks. Can you talk about how that's important and how that shapes the market?
Thank you for the question. It's extremely important, and as I alluded to earlier, a Federal Reserve study, the New York Fed studied that legislation that allowed banks to have sub-S elections, it's the principal reason we have as many that we still do. But it's extremely important that we give that, extend that legislation.
I'll be fighting to keep that. And thank you all for your time, and I yield back.
The gentleman yields. The gentleman from Iowa, Mr. Nunn, is now recognized for 5 minutes.
Thank you, Mr. Chair. I appreciate that. As most Iowans know, their local lender allows their institution to offer pretty customized services, particularly where they live and operate. This could be a farmer, a small business owner, just a fellow dad trying to help out. Iowa has approached our financial regulatory framework, I think, pretty thoughtfully, which is why we still have over 250 small lenders across our community. Many states 5 or 6 times our size don't even have that type of diversity in the lending system. I look forward to reversing some of the damages, Mr. Chair, that were done under the Biden-Harris administration that have hindered lenders, restricted our economic growth, and disproportionately affected rural communities across our country. Mr. Chair, I would like to submit for the record the list of priorities coming from my Iowa Bankers Association, from the Iowa Credit Unions, and our Iowa Community Bankers. This lays out a very good framework of what's working in a place like Iowa, and maybe a recommendation on things we should be doing at the federal level.
Without objection.
Thank you. So let's get to work. First and foremost, Section 1071 rule. I remain concerned that 1071 forces our small banks and to level additional burdens on our businesses. In fact, they're requiring 81 different data fields. Now, that's a 30% increase over what's federally mandated. So this is already something, when we talk about efficiency, we can start looking at. An Iowa bank with just 17 full-time employees wrote to me recently and said, we do not have enough manpower on staff to address the compliance requirements coming out of 1071. It's going to force us to hire another employee. Now, in a small community, when you're spending another six-figure investment to meet a compliance requirement, that's money that is not being spent in that community or helping a local borrower. So, Ms. Owens, I'd like to talk with you. How does the impact to community institutions to report 133 different data fields between 1071 and the beneficial ownership reporting requirement impact a local lender?
Well, it would require us, or it will require us to invest more in the compliance side of complying with this regulation, which absolutely directly affects what we are able to invest in the communities, and not only making loans in the community and staffing loan officers to be able to do that, but also supporting the local food pantries and financial education and many things that we do.
You hit the nail on the head, and thank you for highlighting the ripple effect this has across communities. It's one of the reasons I'm proud, Mr. Chair, to co-sponsor Chairman Williams' bill to repeal 1071. I'd like to also speak to tailoring. Now, institutions of different sizes and business models are purposefully different inherent on where they are. In fact, most Iowa lenders have under $7 billion in assets. But the Biden administration chose to treat every lending institution the same as a multinational bank in New York with $3.9 trillion in assets. Now, with respect to my friends from New York, across the rest of the country, we're talking multi-billions of dollars. You know, for comparison, 7 billion inches is roughly 110 miles. That's enough for me in Des Moines to drive to the birthplace of John Wayne in Madison County. But it would take that same amount of inches if we were trying to talk about 39 trillion inches. From my house, the same distance would be to the sun. So to put that into perspective, this is how we are treating vastly different sums of money and regulation on a small bank that's here to Madison County versus a big bank, which would be the equivalent of from Des Moines to the center of the universe. So, Ms. Marshall, I'd like to ask you, do you think that tailoring regulatory caps to account for inflation would alleviate some of the immense regulatory burden that is crippling banks and lenders right in Iowa?
I absolutely do.
I'm glad to hear that.
And Mr. Nunn, if I may,
Yes, ma'am.
Your previous question about the compliance impact on our institutions and our community banks, in addition to the cost, what I also find that when I talk to bankers is that they're having a hard time finding the talent. Quite frankly, not so much just the willingness, but the expertise, and sometimes it is the willingness of staff that they're going to bring in. And to an earlier member's question about the next generation of bankers, who's going to come into those institutions in those rural communities and take on this massive burden? Where is that resource going to come from? That's another reason our community banks are looking at how can we continue to survive when we don't have the resources, both financially and personnel.
And Ms. Marshall, I could not agree more, because what I want my local lender to do is to help Main Street buy that first combine for a farmer, help a kid get an F-150, not spend most of their time trying to understand regulatory compliance out of D.C. that is outdated, overbloated, and can be rescinded.
It's all about economic development.
Yes, ma'am.
The gentleman's time is up. The gentleman from North Carolina, Mr. Moore, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Today's hearing is about restoring certainty and common sense to the way we regulate community banks. In my home state of North Carolina, of course, Charlotte is part of Charlotte's my district. We have a good number of banks and financial institutions there. We rely on our local banks to provide small business loans, mortgages, and financial services that keep our families and our communities thriving. Many of these banks are locally owned, deeply invested in their communities, and essential to our economy. Yet instead of supporting community banks, the Consumer Financial Protection Bureau, the CFPB, has been driving up costs, increasing red tape, and making it harder for them to serve their customers. And you all have answered a number of questions. I notice this is a common theme of coming back to this same agency. And by the way, thank you for sitting here for almost 3.5 hours. That's been a tough assignment, Mr. Chairman, for these witnesses. Thank you for doing this. But I think we're getting a sense that Section 1071 is a leading rule that's an example of a big government agenda at CFPB. And it seems that this rule, from the testimony you provided so far, the other questions, is forcing small banks to collect, I believe, as referenced already, over 80 different data points on every small business loan application, including intrusive personal financial information on business owners. So it's not just a paperwork burden, as you've all already spoken to, but it is a mandate that discourages lending to small businesses and ultimately reduces access to capital for small businesses, particularly in rural communities, as my good friend from Iowa was just commenting about. The other thing that's very frightening to me in this agency is that the CFPB is operating with no accountability. And I don't know how many Americans are aware of this disastrous policy that was passed and the way it was implemented under the previous administration under President Biden. But it seems that we have a choice, that we can either continue down this path of bureaucratic red tape that will ultimately lead to economic stagnation, or we can institute common sense reforms that allow community banks to lend, to grow, and to support their local economies. So I look forward to working with you all, look forward to working with your peers and my colleagues here in this committee and in the House so that we can get this right. I do have a couple of questions, but I don't want to be repetitive of other questions that have been asked. But the first question would be to Ms. Romero Rainey. In the final days, and this has been mentioned earlier, but in the very final days of the Biden administration, Director Chopra used his final days to issue a flurry of harmful regulations. What I would say is, one, if you had to narrow it down to 1, 2, or 3, which would you say are the most concerning that you've seen? And two, how, if not rolled back, how would these policies affect small businesses and put American banks and businesses at a disadvantage internationally?
So I'm not as familiar with what happened in the last 24 hours. What I think I would like to speak about is to pick up one more piece. As I think about most harmful, I go straight to 1071. And there's one more piece that we haven't talked about as much, and it's the ripple effect back to the small businesses, as you were alluding to. The last thing small businesses need in this country is the commoditized approach to small business lending, which is what this rule would require. And again, as we've demonstrated in multiple aspects, small businesses don't need one-size approach. No two small community banks look alike, no two small businesses look alike, nor should their lenders treat them as if they were alike.
Yes, ma'am. Well, thank you. And Mr. Kennedy, a question for you, sir. The CFPB's scrutiny of non-traditional banking services such as the fintech partnerships has made it harder, I would argue, and I believe there's testimony to this, for banks to innovate and to offer modern financial products. Given that, how would you suggest that Congress set clear limits on the CFPB's role in regulating financial technology? And secondly, how would you define that the current uncertainty is affecting the industry?
Well, the CFPB has a trickle-down effect on banks under $10 billion, of course, and so I think having clear guidelines from the agencies that really regulate banks and understand banks and the relationship with fintechs is extremely important. I think we've all got to recognize in the regulatory and the business world, we've got to work together. Things move very rapidly, and we've got to work cooperatively. So that's my thoughts.
Thank you, sir. I yield back the balance. I give you back
The
25
gentleman yields
seconds of
back.
your day today.
The gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Thank you. Like many of my colleagues, I've been alarmed during the last administration by a steady stream of partisan rules from regulators that failed to be accompanied by substantive cost-benefit analysis, that lacked an understanding of the cumulative effects they would cause, and whose adverse effects would be borne by American families and businesses of all sizes, including by increased costs and reduced availability of credit. We should be doing everything we can to ensure businesses and entrepreneurs have access to the resources they need to thrive and drive an innovative and competitive economy. And we need our community banks to be thriving as part of that effort. I know the chairman's Making Community Banking Great Again principles include ensuring access to diverse sources of funding and capital. So with that in mind, I'd like to touch on brokered deposits. Ms. Romero Rainey and Mr. Kennedy, following up on the question from my colleague, Ms. Wagner, to Commissioner Marshall, Can you discuss some of the ways that community banks use brokered deposits to access funding, which allows them to make more loans to small businesses and families?
Yes, broker deposits have been a significant tool for community banks in a few different ways. One is just as you think about seasonality in a bank's balance sheet. So maybe I'm an ag lender, and so deposits are going to be high in one part of the year and maybe not as much in another. Or in my community bank, we are tourism driven, very much varies the peaks and valleys in terms of the deposit flow. So broker deposits are a critical source of helping to maintain stability in that balance sheet regardless of what those local deposits are doing. And so that provides, they're contractual, they're safe, they're secure, and so it's a great tool for community banks to use.
Mr. Kennedy?
Thank you. Most of our clients and our own community bank don't use broker deposits, but we importantly use deposit networks that allow us to provide federal deposit insurance through reciprocal arrangements. And this has been around for the last 27 years, and it's an extremely important way for us and these community banks to maintain their deposits locally for institutions and individuals that have more deposits than $250,000, particularly a lot of public entities. So it's a very valuable tool. Not many people are aware of it, but it's a way that there's no big cost to it, so it's not the theoretical, and the FDIC has defined that as broker deposits only once you get to a certain limit. So there's not a lot of logic to that, but it's an important element of this whole notion of federal deposit insurance.
Mr. Laurel, may I add a moment on broker deposits that haven't been addressed today? Speaking with my community banks that have used them quite successfully for many years, another very important part is that they're often the most cost-effective source for funding. And so when net interest margins are squeezed and there's an extremely amount of increased non-interest expenses that are going on to banks' balance sheets, that is another reason why they are looking to find all the opportunities to have low-cost funding sources to then turn around and lend money to the consumers that need it most.
Thank you for that. The 2020 final rule on broker deposits was preceded by significant study and public rulemaking with an advance notice of proposed rulemaking, a notice of proposed rulemaking, and consideration of 220 comments before finalization. Last year, the FDIC issued a proposed rule modifying broker deposits. However, last year's proposal featured incomplete data that did not indicate what problem the FDIC saw based on data and analysis that would justify a wholesale rescission of its 2020 rule. It was alarming to me and many of my colleagues that this proposal appears it would have had a unique and negative impact on community banks. By widening the scope of deposits classified as brokered, last year's proposed rule would have increased the deposit insurance fund assessments banks must pay to the FDIC. Such costs would have been borne out by customers in the form of higher fees, higher interest charged on loans, and lower interest paid on deposits. Can any of you speak to that in the brief time that I have left?
Well, I would just say to your point, the rule was made not with incomplete and very dated data in terms of the basis for it. So flawed.
Appreciate it. Thank you. I yield back.
The gentleman yields. The gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Chairman. Thank you for the witnesses for all being here today. Originally set up to be an objective assessment of financial institution safety, soundness, and overall health, CAMELS has turned into an opaque process marred with inconsistency and subjectivity. The management rating is uniquely subjective as it isn't based on any empirical standard. Initially, the management rating flowed from other ratings since it was a logical train of thought that if your bank has satisfactory capital, assets, and earnings, then it was safe to presume the bank was well managed. However, today it appears examiners have delinked the management rating, causing banks to potentially receive an unsatisfactory rating simply because they didn't manage their operations or conduct their businesses how the examiner mandated. As a result of a poor rating, a bank could face limits on acquisitions and potentially higher deposit insurance premiums for multiple years with no way to appeal the examiner's decision. Mr. Kennedy, can you describe how the management rating has been misused over the years?
Well, it's a difficult question because there's a lot of confidential information involved in that, but I think it's just it's a subjective, that's the unfortunate thing about camels. Each one of those ratings and camels are very subjective, and I've seen them in my 45 years of practicing law and representing banks all over the country, widely divergent in terms of those decisions.
Well, does the examiner, when a bank gets a low rating, does the examiner provide a detailed reason for the rating, or is there a mechanism for a bank to challenge that rating?
There is, but it's not effective.
How would you make it effective?
I think I'd make it more open and have an independent agency, as suggested, I think, by the
So
chairman.
you can challenge the rating, but it should be more open, and you would use an independent,
Yes,
to
sir.
fix it, you'd use an
Yes, sir.
independent agency. Thank you very much. Mergers present banks of varying sizes, from community to regional banks, with the opportunity to grow and benefit from economies of scale. They also promote competition and generate cost savings that can be then passed on to customers and consumers. As the number of the de novo bank formations decreases, bank mergers have effectively become the only avenue for increasing competition. Fortunately, under the Biden-Harris administration, bank merger evaluations became more stringent, making mergers more difficult to complete. Rather than making the bank merger evaluation more subjective, costlier, and time-consuming, regulators should seek to provide clarity through objective metrics to evaluate potential mergers. Further, clear expectations and timeliness for merger approvals allow banks to make informed decisions on how to grow and meet the needs of their customers. Ms. Owen, can you explain how inconsistent timelines can impact decisions to merge?
Absolutely. It impacts so much more than people initially think of. It's not only a matter of putting the two banks together, it affects people's lives. There are jobs involved with mergers. There are the communities and decisions made of whether or not branches are going to remain open or whether or not they need to be closed, where operations centers are going to be located. It goes on and on and on. So there's a multitude of decisions and things that come out of or are part of a merger, not just what people initially think of, the combining of two financial institutions.
Do you have any recommendations on how we could fix what the Biden-Harris administration did over the last 4 years when it comes to mergers?
I am very much in favor of what Chairman Hill has proposed with a time frame for completing the mergers, unless there's reason to note not to do so.
Thank you very much for that answer. S2155 directed prudential regulators to create a simplified capital framework for community banks known as the Community Bank Leverage Ratio. As a result, a final rule was approved to allow community banks with a leverage capital ratio of at least 9% to be considered in compliance with Basel III capital requirements and exempt from the complex Basel calculation. The intent behind this section was to simplify the capital regime for community banks, ensure they maintain enough capital to weather a downturn. Ms. Romero, Rainey, at the time of this rulemaking and even in today, would you say that the majority of qualifying community banks that have at least 8% CBLR already meet the well-capitalized risk-based capital ratios?
Yes.
Can you please describe the benefits that community banks saw from lowering the CBLR to 8%?
Again, part of this was to allow for additional flexibility, and whether it's the definition of well-capitalized or as they're looking to pursue other opportunities.
That's a great answer, and I appreciate it. I'm running out of time, so I will yield back. Thank you.
The gentleman yields. I now recognize myself for 5 minutes. Thank you all again for being here. I know it's been a long day. In 2008, there were 64 state-chartered banks in Montana. Now today, there are only 36, almost half. The situation nationwide is not much better. The vast majority of these banks that left the business were small community banks, with crushing regulations being the primary factor. Now, as we've covered throughout this hearing, there are many challenges that prevent new banks from forming or lead to mergers or closures of existing banks. Now, that's particularly devastating for rural communities like Montana's 2nd District, which I proudly represent. So Montana is a heavy producer of cattle, of wheat. It's the #1 producer of lentils in the United States. And Montana banks support over 24,000 small farm loans across the state. Now, these are the family farms that put food on our tables and clothes on our backs, and the biggest obstacle community banks face from examiners is not safety and soundness, but the Bank Secrecy Act and the anti-money laundering laws. You know, these laws have a role in preventing fraud, but are now far past the point of common sense. You know, one bank in Montana with about $800 million in assets has 6 full-time employees doing compliance, you know, roughly half of which is just spent on the BSA and the AML. So my first question, you know, Ms. Owen or Mr. Kennedy, can you, either one of you, talk about the difficulties community banks face with our outdated BSA and AML laws?
I'll start. We have 4 BSA officers, and I'm just under $500 million in size. We do a lot of reporting, as was mentioned earlier, on transactions of $10,000 or more. We never get any feedback back from FinCEN.
So do these regulations make opening new accounts for customers difficult as well?
Absolutely. It takes a lot more time. You can't come in and quickly open an account. You might as well plan to be there for a while.
Thank you. Ms. Romero, Rainey, what should Congress do to fix this?
So first, we need to start with the thresholds. You know, as we've discussed here today, the CTR thresholds that Ms. Owens just referenced were created in the 70s and have not been revisited or indexed since then. So I think there's a real easy and simple fix if there's such a thing, but it's a great place to start.
Right. So thank you for these responses. It's clear that lawmakers and regulators need to do much more to ease the burden on our small banks. You know, no one's hurt more by bank closures than the communities they serve. So I yield back. Thank you. So now I will, the gentleman from Florida, Mr. Herodopoulos, is recognized for 5 minutes.
Thank you, Mr. Chairman. First, I want to applaud you for your endurance. Great job today. I'm your last person. I guess they're saving the best for last. So with that in mind, I first have to say this. When I was running for Congress, I had some concerns about the CFPB. And now that I've actually been under the hood for the last few weeks, I have even larger concerns. And we're so grateful for your willingness to testify today and give an honest appraisal of how it hits the real world. And we're so grateful for this testimony, and I'll try to be brief. The first question will be for Mr. Kennedy, if you don't mind. Can you discuss putting a kind of a shot clock on bank mergers and how that could provide clarity for institutions and help prevent long and drawn-out mergers and that drain resources?
Absolutely. There is no such shot clock, as you say. They can continue to ask questions, and I've seen it go on for years. And so the cost on the uncertainty is, just not workable. And that same shot clock ought to be applied to really every application, including de novos, because the de novo, that's one of the big burdens with de novos, not only capital, but the process of those applications needs to be accelerated.
Well, thank you. And to Ms. Romero Rainey, if I could, the CFPB recently finalized an overdraft rule that I would be concerned about because, again, it's overly complex and could really limit or eliminate consumer access to funds that could help cover emergency expenses. Would you discuss some of the problems that you faced or potentially faced with that rule?
Yes, so to your point, it's about limiting options. And while in the rule, in all fairness, community banks under $10 billion were exempt from the rule, there's 2 pieces that worry, as we've talked about today, trickle down and what that means in terms of how this will be applied to community banks, as well as specifics within the rule that say that could be revisited over time. And so at the end of the day, this is about ensuring that consumers have access to products and services, and in these cases, very well disclosed services that they've chosen to pay a fee for.
And Mr. Chairman, with that, it's been a long day. I want to yield back my time so these folks can get back on to the day. But thank you very much for making the time for us. It's been very helpful, especially as a new member of the Congress. Thank you.
The gentleman is modeling good behavior. He yields back. That is appreciated by our witnesses. I want to thank all of our witnesses for your outstanding testimony today. Thanks for presenting your views to the committee. It'll help us in our work. Without objection, all members will have 5 legislative days to submit additional written questions to the witnesses, to the chair, and we will forward those to you for your response. I ask our witnesses to respond no later than March 31st, 2025, to those written questions. This hearing is adjourned. Thanks.